for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The impact of the full energy crisis because of a warm winter. Gas prices, I suppose, are no longer falling, and they are, though, in terms of storage levels, still at quite high levels. So that is important. But Eurozone consumers do seem to be more sensitive to the fact that other areas of inflation are still higher as well.
Janet Henry there, the global chief economist at HSBC. What's happening with the commodity market in Europe? 2023 has turned out to be so much better than we thought it would be in 2022, particularly through the winter for the likes of Europe. There was a moment there last summer when there was this real fear about Europe's ability to get through the winter and heat homes. And Lisa, it managed to do that. So when we talk about stagnation in Germany, recession through the winter, it was a mild one, let's put it that way. And relative to what we expected 12 months ago, that mild recession was so much better than what we thought it would be.
And there also have been questions around understanding the dynamics of a crude market, of a natural gas market. I mean, yes, natural gas very much explained by the mild winter, but crude prices being as low as they were defied expectations of a China reopening, of robust travel seasons, of all of the use that we see around the world. So what's going on, and should it go higher? Amrita-san was talking a lot about how it should go higher. And then it never really happened until recently. We started to see a little bit of a tick up.
Amrita-san joins us now, co-founder, head of research at Energy Aspects. Amrita, wonderful to get your input on this conversation. Lisa mentioned you there. It was the commodity rally that never really was this year off the back of China reopening. Yeah. What happened?
Oh, I think the China reopening probably gets too many fingers pointed at it. I think Chinese oil demand has been very strong. Gasoline jet has been growing. Overall demand's been up about 2 million barrels per day. That's not been the problem. I think the problem has been that we have destocked an enormous amount of crude, and the more we go through the numbers, I firmly believe we've ended up, with a lot of oil in floating vessels without their AIS transponders turned on. So they've just been absorbed gradually, but definitely over the last few months, particularly in China. You can see a very, very big discrepancy between what tanker tracking data shows going into China versus China's own import numbers. So a lot of these kind of shadow vessels, mostly Iranian oil, has just been seeping into the market. And I think that's kind of allowed the market to absorb effectively more supply and has put a cap on prices. But it's also a function of higher interest rates, and which is something we've been highlighting, that people are just not willing to hold inventories. Now, I think you're getting to a point just outright inventory levels are very low. And as a result of that, you are starting to see prices move up. And this is something we'd always said is going to happen in the second half of the year as balances tighten and as demand goes up. So I think we're finally seeing that.
So you're expecting a restocking of inventories. Can you give us some kind of numbers, the kind of place you'd expect to see that in a bigger way?
I don't expect to see a restocking in inventories for the simple reason that we're not going to be in a low interest rate environment anytime soon. I think 5% interest rates does change the dynamic quite significantly. I think you're seeing this much more in oil products. If you look at gas prices in the US, or gasoline prices, diesel prices, they are roofing right now. And I think that's a function in high frequency stocks data that we collect is at a record low across oil products. And I think that's the problem, that it leaves the market susceptible to spikes like we are seeing in gasoline and diesel. And I think that's where I think the risk is for crude as well. On average, we're probably going to 2 to 3 days lower inventory forward cover because people don't want to hold inventory. But that has its own risks. And that's kind of the problem, I think, or the challenge for the crude market.
So let's just frame this a little bit more clearly, just so that I'm sure that I'm understanding it correctly, Amrita. Basically, money costs something now. So people don't want to take that credit, that opportunity cost, and put it into holding physical barrels of crude, which is the reason why prices have not been higher despite the increase in demand. So what trigger could cause those prices to spike, could cause people to suddenly say, wait a second, maybe it's worth not getting 5.5% in cash and storing oil barrels in my living room because prices are going up because there is such high demand?
No, so the first part is exactly right. It's just too expensive, and therefore people don't want to hold inventory. But I think what's happening now is once you've run through that inventory, you still need crude oil to meet demand. We are very hand to mouth now, but once we've run down that inventory, what you're seeing now is refineries coming and saying, demand is very strong, we need to run, therefore we're buying crude. That's the cycle you're seeing. My point is that if you are this hand to mouth, the risk is you need only one supply outage, and then you start to spike like you're seeing in the products markets. You've had a lot of refinery outages and you keep seeing products spike because you just don't have that buffer in the system anymore.
5 days ago, we saw U.S. gasoline prices at $3.59, $3.60. Now they're $3.71. So rapidly climbing. How high could they go in your estimation based on the supply demand dynamics that are potentially going to underpin more increases?
The good news for the consumer is that we are switching to winter gasoline very soon, and that's when the specifications are less stringent and gasoline prices at the pump come off. But underlying both gasoline and more so for diesel, inventories are very low. So yes, we can actually continue to see prices go higher, especially because with the heat wave in Europe and parts of the US, we've seen refineries really struggle to process crude right now.
What happened to the SPR getting refilled, Bramo? Do you remember that?
Yeah, it was supposed to happen. It didn't.
It just didn't happen. Amrita, what happened with that?
It's happening.
When?
It's happening.
It's happening in small trickles, like 3 million barrels in August, 3 million in September, 3 million in October. So it's going to be a very, very slow trickle. But this is the other thing, by the way, and we remember there's another loan that needs to get repaid from November 2021. That's going to be in 24 million barrels going back into the SPR from that. I mean, we don't have inventories, and this is why I keep talking about the destocking. If you have very low commercial inventories to begin with, imagine taking more crude out of those commercial inventories to put back into the SPR. There is going to be more upward pressure on prices. Of course, the good news, I guess, again, from a consumer point of view, is that OPEC Plus has the spare capacity now thanks to those voluntary cuts, so they can bring back production gradually. The additional voluntary bit I'm talking about, the Saudi Arabia 1 million, Russia 500,000 barrels per day, they can start bringing that back whenever that is required should prices go up too fast. But other than that, we don't have much of a buffer.
We used to joke that it was the strategic midterm reserve, but in all seriousness, do you sense that the SPR will be used politically going into the election next year, just in terms of a reluctance to rebuild it aggressively?
Well, the SPR has been used politically. I mean, sure, at the start of when it was released last year, everybody thought Russian production would fall a lot more. It didn't. But when it was very clear that it wasn't falling, there was no need to continue with the SPR release, right? It was very clearly driven by trying to keep prices down. And that's been a very clear objective of the Biden administration to, be it allowing some more Iranian sales to happen quietly or Venezuelan sales. So all of that's been going on. I don't think they have much more ammunition given where SPR levels are to release much more next year. But yes, I do think the pace of refills could easily slow down, again, barring those loans, because why otherwise push prices? We're already at 83 Brent, couldn't continue to go higher, especially given demand is actually looking pretty robust everywhere. Then why add to the pressure? So I'm not expecting a big refilling next year anyways.
Amrita, thank you. Amrita Sen there of Energy Aspects on global inventories and oil supply right now. Brent crude, Lisa, 83.92. A bit lower today by 0.4% on WTI 79.85, a little bit lower by a third of 1%.
To me, this is the main sleeper story that people are not talking enough about, because if we do see gasoline prices go up significantly, not only is there a huge political question there also is a consumer price index component of this. How much of the declines that we've seen have been somewhat fueled, excuse the pun, by what we've seen in oil prices, energy prices coming lower? If that reverses, how much does that upend some of the gains that we've seen on a year-over-year basis and make people feel less well off?
The gasoline price is 8-month highs. That is something to watch, not just for the economics, but the politics, the election campaign going into next year.
And you raise a great point. How can they start refilling a strategic petroleum reserve at a time when there's an even greater premium around storage, where people demand more that will increase the price that much more on the margins? How can they do that if they are concerned about where gasoline prices are?
At this rate, how long would it take? 6, 7, 8 years?
I don't know the math.
To get it back to
something like that.
Where it was. Jay Pulowski of TPW Advisory is going to join us a little bit later. The enthusiasm for the international backdrop at a time when a lot of people are becoming increasingly enthusiastic about what's been developing here stateside after some pretty strong data in America yesterday. GDP, jobless claims lower, GDP stronger. Going into the employment cost index, Lisa, a little bit later.
80% of companies have beat, albeit lowered, expectations. So you see that pretty much across the board in earnings as well.
I saw that stat from Mislav Matejka at JP Morgan this morning. Compare it to Europe. Europe not getting it done.
Yeah, and you've mentioned this before. This is actually key, maybe even more than ECB policy at this moment.
Equities right now on the S&P positive by 0.4% on the S&P 500. Live from New York City this morning. Good morning.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
To stop if they can.
A lot of companies are feeling that strain and will continue to do so as those rate rises.
Really still an earnings story.
They seem to be guiding us to a slower pace of policy.
The bigger risk is for the Fed is to declare mission accomplished too early.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market with a lift on the S&P 500. The earnings so far this week, pretty decent. The economic data in America, pretty stellar. And a Fed chair, Jay Powell, telling us nothing about what he may or may not do in September. The BOJ, even more unclear about what they did overnight. Some yield curve control tweaks, Bramo, from Governor Wader.
It is shockingly stable in markets given the uncertainty and ambiguity, which is new terrain for all of the central banks, in particular the Bank of Japan. And you've said this before, John, and I think that it's the right take on this, which is it is too early to say what the market's reaction is going to be to the Bank of Japan. You've said that several times, and you're absolutely correct. It is too early to see whether people can truly buy into the soft landing narrative and the strategic ambiguity by all of the central banks and just be okay with it.
Well, let's talk about what they've done. They've still got a target of 0. They've got a ceiling of 0.5, but they seem to allow maybe a drift above 0.5, and they're not going to address that with, what did they say, rigid, in a rigid way?
Yes, correct.
Okay, that's the new word. And ultimately, if it gets to 1%, they'll step in every day and buy JGB 10-year yields at 1%. So where's the line in the sand now? Where's the market going to push this? We've seen a 10 basis point move overnight, which in Japan is a real move. Let's be clear about that. Do we push this to 0.6, 0.7, 0.8? Do we go all the way up to 1%?
When do they start getting uncomfortable? When do they start stepping in? How much is this really dictated by the yen? How much is this trying to get the yen a bit stronger after it became one of the weakest that it's been in decades on a real basis, just simply because people expected them to retain these kinds of policies? These are some of the ambiguities. The bigger question has been, what impact will it have on broader markets? And Jeff, you were saying, maybe they have just shown they don't have to have that much of an impact if they do it slowly, if they do it with strategic ambiguity.
Well, so far, so good. You're going to hear that phrase a lot this morning. 5 days of yen strength at the moment. The dollar against the yen. Dollar yen negative by, let's call it 0.2% this morning. Let's check out the price action just briefly on the S&P 500. Equity futures positive by 1/3 of 1% on the S&P. Yields a little bit lower by 2 or 3 basis points on a 10-year, 397. As we said a few times this morning, if you are just tuning in, it's worth repeating. The move in treasuries yesterday off the back of the Nikkei report about what we eventually got from the BOJ this morning. So the move in treasuries, Lisa, was really yesterday, and throwing some strong economic data into the mix as well.
Which is the reason why you're not seeing the move today. The idea that we saw the biggest move in 10-year treasuries going back to September on the heels of the Nikkei report, perhaps people reassessing today. What I'm watching in about an hour, German CPI for the month of July. To me, this could be one of the most interesting things that happens, especially out of the prints out of France and Spain, given the fact that Eurozone inflation, core inflation, is running still very hot and about 5.5%. 5.5%. 8:30 a.m. in the U.S., PCE deflator for the month of June. The employment cost index for the second quarter, the key index that the Fed looks at for wage increases in personal income and spending. How much does this key inflation metric, core PCE, really start to come in, given how sticky it's been? To me, again, which data matters in this increasingly data-dependent, strategically ambiguous central bank morass that we've been thrown into this week? And at 5 p.m., Iowa GOP Lincoln Day dinner happens, and it is the first time that the former President Trump and Florida Governor Ron DeSantis are expected to meet up with all the other contenders. It's going to be interesting.
That'll be fun. Let's see if they're on the same stage a month from now.
Yeah, exactly. Good question.
Debate. Still don't know the answer to that, do we?
And exactly what the tenor is going to be, because both of them have their issues that they can go after each other with. You know, you've got the former President Trump dealing with a whole host of legal issues, which I'm sure we'll talk about with Anne Marie. And then you have Ron DeSantis losing, a third of his staff and firing people, not being able to raise money.
Have they left or he's cut them?
I think that he's cut a number of people because of the budget cuts. But I have not spoken to them personally. I do not know.
Okay, we'll try and find out. Have you seen these Procter & Gamble numbers?
Yeah, pretty good.
On the top and bottom line, revenue in at plus 8%, the estimate plus 6%, EPS growth 6 to 9%. Revenue came in really strong. Lisa, EPS 137 against an estimate of 132. There's a beat here, there's a beat there, and higher prices. And it looks like they've still got the pricing power at P&G.
And the fact that margins expanded, given the fact that even though they are seeing fundamental prices come down, they can still pass along increases in pricing to consumers. We've seen this from consumer-facing companies, one after another: Coca-Cola, McDonald's, now Procter & Gamble, in addition to the tech names. So at what point does this feed into the idea that maybe a soft landing isn't so perfect if you still are seeing these increases in prices and things of that nature? I mean, these are some of the things people are talking about. Have we gotten too comfortable with this idea that the Fed has won and that actually we're now going to have this immaculate disinflation? It was just delayed. It wasn't.
Well, two things. One, I think you can make the observation that this is pretty impressive based on what we expected.
Sure.
But two, it's very different to extrapolate that out several quarters and say this is the ultimate destination and this is where we are and they can take a victory lap. It's far too soon to make those conclusions.
And it's also important to realize that overall sales are down somewhat, and that Q2 profits for S&P 500 companies are down about 8% so far if you look at a number of different tabulations. So crossing a low bar, I think, and lowered expectations is one way of looking at it.
Do you have favourite guests? Do you have like a top 5?
Yeah, of course.
I've got favourite guests. Here's one now. Jay Pawlowski, principal and founder of TPW Advisory. Jay, it's good to catch up, buddy, as always. Can we start in Japan, just briefly? The latest change from the BOJ. I know it's an equity market, Jay, you've been looking at more closely. Did you like what you heard this morning?
Yes, I think Japan has had success at something that they've been fighting for 40 years, John, right? Which is to get rid of deflation. And they've done that. They now have inflation. And so we like Japan as an equity market. It's set up beautifully. The currency is super cheap on an OECD purchasing power parity basis, 50% undervalued. Stocks are super cheap, right? You have stocks that sell for less than cash. I think 20% of TOPEX sells for less than the cash that's on the balance sheet. We like Japan a lot. We think the BOJ is exiting yield curve control. That's going to set off not only a potential allocation out of foreign assets, which is what Japan institutions have been doing for years, back into domestic assets, but also within the domestic asset allocation, where the famous Mrs. Watanabe, the retail investor, has been doing nothing but buying bonds. Now bonds in Japan are going into the same bear market that U.S. bonds and European bonds have been in for the last, year and a half or so. And so that means a allocation shift to equities. And so Japan is, we think, one of the most attractive markets in the world at this present moment, looking out on a 6 to 12-month basis.
Jay, just to build on that, yesterday evening I was going through some decks, some slides from Apollo's Torsten Slok on Japanese banks and looking at net interest margins. It was shocking to see just how narrow those net interest margins are at a Japanese bank compared to, say, a Wells Fargo, which is at a multiple of that. Jay, would you play it through the Japanese banks, and how much of a move have we already seen anticipating what we got this morning?
Yeah, the banks have moved first, obviously, because as rates go up, that issue that you spoke of gets helped out, as we've seen with U.S. banks, right? We've been in this extreme low rate environment, and one of our key conclusions, Lisa was talking about strategic ambiguity, brought me back to my national security days studying for a master down in D.C. But they're looking to do something different, and the opportunity is to grow the economy and to have inflation come back, and that helps the margins, that helps earnings. And just as we look at it in the U.S., right, high nominal growth, John, you remember we've been talking about this for ages, high nominal growth. The same thing applies in Japan, which is why you're going to have good earnings, you're going to have good bank results, and again, you're not paying anything for it. Less than cash, 20% of the market sells for less than the cash on the balance sheet. It's a value player's dream. It's a growth player's dream. The currency's going to appreciate. Rates are going up. Bonds are going to sell off. People are going to buy stocks. Really, I think it's a fantastic setup.
To be clear, it was Jeff Yu who coined strategic ambiguity. I was just parroting a perfect explanation of central banks this week. You say a value player's dream over in Japan. What about in Europe, which you have been overweight? Is there still a value player's dream in an area that has disappointed in a way that the U.S. has not?
Yeah, I mean, Europe has more of a challenge on the economic front, Lisa. I think that's pretty clear. But I think, again, the sentiment, look, one of the things that we've been talking about is this tremendous gap between data and surveys, and sentiment. And the data continues to come in pretty good, and the surveys and sentiment continues to be, for the most part, pretty lousy. And data is winning out. And the same applies in Europe. You talk about banks, right? John knows this. And Lisa, we've talked about it over time. We've been a buyer and an owner of European financials for the last several years, and they continue to hit new highs. Just hit new highs in the last couple of weeks. So we think the situation in Europe is better than it's being portrayed. But to be clear, we were bullish Europe last year. We've been bullish Japan and Asia this year. We've talked about rotation. We wrote a piece called Rotation 2 months ago. That's been what's going on in the markets. We have a rolling rotation. So now, looking forward, we're all about what's next, right? We want to look forward because markets are moving very, very fast. And so to us, what's next is we have clear skies. We have a manufacturing recovery. I think that's what's going to be the surprise in the second half of the year. Manufacturing is going to pick up as we restock the inventory drawdowns that have taken place. You're just talking about that on the oil side. One reason why we're bullish energy is exactly that thesis. And so we think the big opportunity right now for the next 6 to 12, 18 months is in emerging market equities and commodities, both of which are at 15 to 20-year lows relative to the U.S. equity market, as an example. So lots of upside in those two segments.
Do you need stimulus out of China to make that work, Jay?
No. We think China is, again, China's another, the poster child for negative sentiment. Just ridiculous about how negative people are about an economy that's a, massive, second biggest economy in the world that's growing at 5%, double the United States. It's growing at 5%, John, with pretty much an assurance. And they're making shifts, right? They're welcoming back the tech companies because they need them. So the whole issue around China tech is over. And one of the things we've talked about in the last couple of weeks, take some profits in U.S. big tech, reallocate back into China tech, things like K-Web, et cetera. We think emerging markets are going to lead the next cycle in central banks, which is rate cutting. Right? We're at the end of the rate hiking cycle in the West, in the U.S. and Europe, maybe just beginning in Japan, fair enough. But emerging markets are going to lead the rate cutting cycle.
Yeah.
And we think markets like Brazil are very attractive. We like China. We like Brazil in particular. Within emerging markets right now, we like Japan. And then within the commodity space, we like energy. We like industrials. We like precious metals. Commodities, we think, are really the next thing. And they're breaking out. Again, within the last 2 weeks, WTI has broken out. Goldman Sachs commodity index has broken out, and that's telling you that we're not going to have a recession. So bonds priced out recession first by getting rid of the rate cut for next year, for this year, second half of this year. Then stocks with the move into cyclicals, and now commodities are pricing out recession. So you're not going to have a breakout in commodities in a recession, right? Those two things don't go together.
Jay, this would have been easier if we just started the interview by saying, what don't you like? You know, this would have lasted 30 seconds. Jay, it's good to hear from you. We've got to let you go.
He doesn't want
Jay
to
Pawlowski.
go. He'll come back.
Let me tell you what I don't like. You. We get along, don't worry. 7:30 a.m., 20 minutes away. Tony Rodriguez and Nuveen on Fixed Income from New York City this morning. Good morning.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Concerns about your Democratic colleague, Dianne Feinstein, as well. Is it time for many of these individuals potentially to step aside and make way for a new generation of leaders?
Look, they'll have to make that decision themselves, but members ought to be able to do their jobs. Members ought to be in a place where they can perform the duties and responsibilities given to them by their constituents. And I'm hopeful that both of those individuals make the decision based upon that criteria.
Steny Hoyer there of Maryland, the Democratic congressman. Speaking of Bloomberg's Anne-Marie, we'll catch up with AMH in just a moment. Live from New York City this morning. Good morning. Plenty of feedback about Jay Pawlowski and his optimism. That feedback is welcome. Your equity market on the S&P 500 positive by 0.5%. Yields are lower this morning by 4 basis points to 395.66. Taking back some of the move from yesterday, Lisa. Yields much higher, of course, off the back of stronger than expected US data and a suggestion that we'd get a yield curve control shift from the BOJ. And this morning, that's what we got.
Haven't you been a little bit surprised that all of the strategic ambiguity, I'm going to keep cannibalizing this word, this phrase, hasn't created more volatility, given the fact that we could be nearing the end or the beginning, depending on which region you're in, of some very new cycle?
I'm going to borrow someone else's phrase.
Okay.
Used to get these financial stability reports from the Bank of International Settlements, and they're always pretty bearish, actually, on global markets.
Oh, I know. I love reading them.
Do you remember them in the old days when rates were too low and all of that good stuff? And I remember this phrase in there, an uncomfortable calm. There's an uncomfortable calm right now going through the summer. There's this belief that we can get the optimal outcome, the soft landing. That belief is not shared by everyone, but even the people who don't think that materializes thinks that the data will carry on looking that way this summer. And I think that underpins this uncomfortable calm right now. Can you really extrapolate out current conditions 3 months, 6 months into next year?
And it's an uncomfortable calm because it's very difficult to be bearish after being so wrong about being bearish during the first 6 months. And it's difficult to be bullish after the gains that you've seen. And so you just kind of sit in there waiting to understand which direction we're going in from data that may or may not show it soon enough, whether or not you believe that the year-over-year comps can really provide that true read.
It's far more uncomfortable if you've missed out the 40% move
Whatever.
in the NASDAQ 100. Anne-Marie joins us now down in Washington, D.C., AMH, our chief Washington correspondent. Anne-Marie, you know where the conversation's been in Washington in the last 24 hours. It's an aging Senate and more, I would say, upsetting pictures coming from Washington, this time of Dianne Feinstein. Can you tell us what you're learning about the future of some of these policymakers?
Well, actually, Jonathan, today in the Washington Post, the data they have is that in terms of incumbent legislators in Congress, this is the oldest we have seen of a class. So, of course, there was the concerns about Senate Minority Leader of the Republican side, Mitch McConnell, when he froze on camera for about 20 seconds. And then yesterday, Dianne Feinstein, who is newly back in the Senate, remember she had taken some time off to recover from shingles, she seemed confused in an appropriations committee, and she looked down to start giving a speech, but really she only had to vote aye or nay, and then she was prodded to just vote. She did it, and then she was told by the senator next to her, just say aye. So she was very confused, it looked like, in this moment, and then she was basically told on camera with a hot mic how to vote. So this just raises fresh concerns over whether or not these individuals at the moment are fit to do their job.
Wasn't it Nikki Haley early this year who raised the proposition, or at least offered the idea, that perhaps we should have competency tests for people in Washington, D.C.?
Yes. Also, Jonathan, when you look at some of the data in terms of the polling, many people want to see term limits for these congressional leaders. Others want to see, if there's not going to be term limits for some of them, they want to see upper age limits on them. Now, we should note, a lot of Americans think if you are 70s or 80s, but you have the mental capacity and you are fit to serve, then you should be able to do so. And you probably bring a great deal of knowledge. You are very wise to the legislature. But if you are not, they definitely want to see something happen where we are not in this position where individuals potentially are concerned or confused about where they are, and they're supposed to be legislating on behalf of the American people.
And Rand, a much more practical near-term consideration. Mitch McConnell's future is really a question mark at this point, with even some in the Republican Party wondering who could follow him as the GOP minority leader in the Senate. Some people pointing at Senator John Thune of South Dakota as a likely successor. What's the latest on that?
It'll likely be an individual named John. There's about 3 senators with the name of John that could potentially take on this role. John Thune, John Cornyn. They are likely potentially to be the next successor for the senator. Obviously, anything can happen. Nothing is set in stone, but these are part of his leadership team now on the Republican side, and they could potentially take the reins. But we should note Mitch McConnell, and everyone has come out, and he's come out, talked to reporters, and he seemed fine. He wants to remain where he is at the moment. And I thought he had a very good politically astute moment when he went back out and spoke to reporters and said, actually, the President of the United States called me, Joe Biden, and I just told him I got sandbagged. So he immediately reminded reporters on the other side of the aisle there also are individuals that people are questioning about their age. And obviously he was talking about the president who tripped over a sandbag earlier this year.
Look, and this is an issue on all sides, and it's not a partisan issue. It shouldn't be a partisan issue. There's a real question about just generally the composition of the legislature. There's also a question, Anne-Marie, about who the leaders will be at the top of both parties. If there is some sort of turnover, does the balance move more to the fringes or does it move more to the center? Is there an idea as there is discussion about new leadership?
Well, that's a great question. I think it truly depends. I mean, a lot of this depends on what congressional district you're looking at. A lot of this depends on what state you're looking at and the Senate race it is. And then also it comes down as well on the presidential level. There's a lot of concerns as we gear up for 2024 and that November presidential election about the age of right now who would be the top candidates on both sides, the nominees, about both their age. It's not just that the president is in his 80s and at the end of a second term he'd be 86, but it's also the fact that many think the former president, Donald Trump, besides the fact is he is dealing with a tremendous amount of legal issues, he is in his late 70s, and many would say that he's an unhealthy man as well. So this is by and large a huge problem on both sides of the aisle. But likely, if you're going to see a new generation of leaders, potentially it goes to what many would call the boomers, I guess those in their 60s, and then much lower, 40s, 50s. And you're seeing them emerge on both sides, but they're not at the top level just yet.
Can we talk about the latest indictment for the former president? Anne-Marie, what have we learned?
Well, the latest indictment, Jonathan, is that the president now has fresh charges against him in the documents case. So everyone yesterday was waiting on the indictment about overturning of the 2020 election results, the January 6th indictment. Trump's lawyers were at the DOJ yesterday, but that never came. What we have are fresh charges when it comes to the documents case that's being prosecuted now outside the Southern District of Florida. And this is two issues in this case, this latest indictment charges. One is that Trump wanted to amend to get rid of surveillance footage. And there's a third defendant that is charged in this case as well, another worker at Mar-a-Lago. The second is that he wanted to conceal a willful retention of national security documents. Now, remember, there was a leaked audio about this and a conversation in Bedminster, his golf course in New Jersey, about a very sensitive document about the U.S. potential military plan in another country. These are the two latest charges in that same case in Florida. This is the documents case.
What a bizarre time it is down in Washington. Anne-Marie, thank you. AMH in Washington, D.C. on the latest. If you are just tuning in, welcome to the programme. As we get you towards the weekend, your equity market with a lift, 0.5% higher on the S&P 500. This from Apollo and Torsten Slock this morning. In sum, for markets to continue to trade higher, the soft landing must be a soft landing, not a reacceleration. Because if housing and consumer spending accelerate from here, the Fed will have to raise rates a lot more. That just in from Torsten. We'll pick up on that in a moment. Tony Rodriguez and Nuveen up next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
Equities with a lift this Friday morning. Good morning to you. Going towards the weekend with equities positive on the S&P 500 by 0.5%. On the NASDAQ up by 0.9%. The NASDAQ has looked pretty good, hasn't it, all year? It's been backed up by the earnings we've had so far this week. From Google, from Facebook, the Russell of small caps positive too by 0.55%. In the bond market, 2-year, 10-year, 30-year. Yesterday, Treasuries lower. The data pretty decent. This morning, Treasuries rally, yields are lower by 4 basis points, 395.66 on a 2-year, down 6 basis points to 486.82. 2 CPI prints between now and the next meeting. The first one, August 10th. The next one, September 13th. The next Federal Reserve meeting, September 20th. And Jackson Hole, back end of August, I believe, 24th to 26th of August. Unclear. Always is, Lisa. We often talk about this. Chairman Powell's going to deliver a speech. I mean, he might do. It's unclear as to whether he will do.
Wait, are you saying, and you made the suggestion yesterday too, maybe he just doesn't show up.
Maybe he won't.
Maybe he just takes August off. I mean, strategic ambiguity is strategic absence as well.
Exactly.
Hello, summer.
Hello, summer. Take a break. After the financial crisis, there became this almost expectation that we would always get this speech from the Federal Reserve Chair at Jackson Hole. We probably will. I'm just saying, maybe we won't.
And maybe it'll be 6 minutes. Maybe it'll be 4 minutes. I think the issue is, if he does give a speech, what can he say if he basically said nothing at the press conference by design? If he's herding cats of different philosophies economically and looking at data that could tell you 5 different stories depending on how you wanted to read it.
And by herding cats, you mean the people on the committee right now on the FOMC.
Exactly, yes.
Given the difference in views at the Federal Reserve at the moment. Chairman Powell expected to deliver a speech at Jackson Hole. We'll see if he does or doesn't. Mike McKee will be the first one to tell us, no doubt. Let's turn to foreign exchange, to the euro. The euro this morning just in and around 110, 110.14, turning positive in the last, I would say, 20 minutes or so. We're positive there by 1/3%. Under surveillance this morning, your top story, the BOJ rounding out the week of central bank decisions with a surprise easing of what they call in Japan yield curve control. The governor of the Bank of Japan keeping the target for the 10-year yield at around 0%, but this 0.5% ceiling is now being called a reference point and not a rigid limit. Read between the lines. The governor's saying this isn't a step towards normalization. We're still far from where we can raise short-term interest rates. So clearly, we don't want to talk about raising rates, Bramo, but ultimately, there's a shift in the tolerance around the ceiling for a 10-year yield in Japan.
When we got the rumor of some shift yesterday from the Nikkei reporting, the market was concerned, and you could feel this. It was a pretty significant hold up. What do you mean? Nobody's expecting this. What are you going to say? And then he comes out and he says, I don't know. What did he say? He said, basically, we're not doing something, but we are, and we're always going to be data dependent. And here we are with relative calm. And to me, how much freedom does that give them to move further, to make further adjustments, given the calm that we've seen certainly today?
Huge if, and I know we're both on the same page, if it continues. Sure. If that calm continues, and so far, so good. In Europe, fresh data out of the Eurozone showing Germany just about exited this winter recession it's been in for the last couple of quarters. output stagnated. So that's the win. The good news, they're no longer in recession. The bad news is that output stagnated. GDP unchanged for the previous 3 months. We were hoping, can I say hope? Lisa, this is what hope is in Europe for Germany at the moment. We were hoping for 0.1% growth, according to estimates.
We still have projections by global bodies that Germany will be the only developed economy that will be in recession this year. They are expected to be in recession for the full year at a time when previously it was thought they hinged on exports that go over to China. Is this still a China story, or is there something else going on structurally with the biggest economy in Europe that creates a real challenge, especially with monetary policy, but also for the overall getting out of inflation without stagflation that really could be pernicious?
It's a struggle. So that's the latest from Europe. Here's the latest from P&G, Procter & Gamble. What do you do if volume is down? How do you achieve revenue growth? Well, you put prices up, don't you? And that's what they've been doing. And they've got the pricing power to do it. Let's be clear about it. P&G this morning up by 1.7%. We've seen it from Procter & Gamble. Lisa, beat on the top and bottom line from P&G this morning. And pricing power is back. And it looks like the consumer is still tolerating it.
Have you ever bought Tide Pods?
Because I've got Tide Pods, yeah.
Me too. They're pretty expensive. And actually, if you go into...
You don't do them on Prime Day. Do them on Prime Day.
You load up? Where do you store them? In New York City apartments? Where do you store them?
We've got storage.
You've got storage. Okay, well, I will just say that in the local drugstore, they're locked up now currently because they are that valuable and the Tide Pods are pretty expensive. My point here is they do have pricing power, and you see gross margins increasing, especially as input prices come down. So they aren't having to spend as much to make said Tide Pods, but they still cost.
I have the luxury of having the washing machine and dryer in the apartment, which is, I know it's a luxury for Manhattan. And if you're sitting here in the United Kingdom or elsewhere, yes, truly, that is a luxury for a New York apartment to have a washing machine and a dryer in the apartment. And then I pile up the Tide Pods down the side in that little cupboard thing. Just
That's so in character.
You don't buy them in bulk.
Perfectly. I do buy them in bulk, but you just have them like stacked up perfectly?
Individually. And take out the pods and just put them. No, of course
it's like
I don't.
Building blocks.
Ramo, stop it. Tony Rodriguez joins us now, head of fixed income strategy over at Nuveen. Tony, we're not going to talk about Tide. We'll talk about the BOJ. What have we just unleashed at the Bank of Japan this morning?
Well, good morning, Jonathan. Good to be with you. So I think with the BOJ, the market's surprised by a bit. I think everyone expected that yield curve control would be addressed probably more in the fall. So they maybe done it a bit early, but they certainly did it in a bit of an ambiguous way with putting maybe this 1% ceiling, but it's a reference rate at 50. Our view is that 10-year JGBs, probably fair value, are in the 75 to 85 basis point area. So we think that 1% ceiling is one that wouldn't be hit anyway if they completely loosen yield curve control. So I think this is a small step ultimately in the direction of having a firm ceiling, probably at 1%. But given the conditions of the Japanese economy, although inflation is certainly, stronger now than it's been any time in the last 30 to 40 years in Japan, we don't think it's going to be at elevated enough levels, and growth will not be significantly strong enough to really drive 10-year JGB yields significantly higher than where we are right now.
Tony, 25 basis points in a place like Japan and the Japanese government bond market isn't nothing, it's something. Can you tell me how you'd expect domestic investors to reallocate away from international stories, perhaps bringing money back home?
I think you're going to see a modest amount of reallocation, but at the end of the day, you're still seeing significantly higher yields abroad. As long as hedging costs eventually begin to decline, because those have been quite stubborn. We've seen hedging costs for the euro decline pretty dramatically from peaks that we saw last year, whereas yen hedging costs have stayed very high. If those begin to ease, I think, again, you will see some reallocation, but we don't think it's going to be seismic by any means. So ultimately, it's going to be about, hey, what's the best total return value you can find across broad capital markets for a yen-based investor? And in that equation, we still think areas outside of Japan are going to remain pretty attractive for the Japanese investor.
Taking a step back, the era of forward guidance seemed to have died this week, both from the Fed and the ECB, and at some levels the Bank of Japan as well. Where does that leave you? How does that shift your view going out about a gradual move lower in U.S. yields and just a gradual lean into duration?
Well, Lisa, it's tough to have forward guidance when you don't have any idea where things are going. And certainly central banks have had difficulty forecasting where we're heading. from our perspective, really the key driver about where monetary policy is going, certainly in the U.S., but also abroad, is obviously the inflation metrics and the underlying economic strength. And from that perspective, we do think you're going to continue to see improvement on the inflation story, but not significant enough improvement that's going to allow central banks to say mission accomplished. The big issue is on the growth side. And while growth has surprised to the upside in the U.S. and kind of globally, we would argue, we think that's just merely a delay in what's ultimately going to be slowing economic growth. If we take the U.S. as an example, it's certainly been more resilient, whether it's because of the CHIPS Act and infrastructure spending on the fiscal side, whether it's because of the consumer being more resilient due to a very strong labor market and excess savings. As we look forward, we think that those excess savings are basically spent. You're hearing that from many of the banks in their earnings calls, that consumer balances are back to where we were pre-pandemic. So that will no longer be a support. When you look at the manufacturing sector, we're seeing some modest slowing there. So our view is that you're going to see a slowdown in the second half, ultimately potentially a very mild recession early in 2024. So it may look like a soft landing or feel like a soft landing in terms of not seeing a significant rising unemployment rate, but it will be enough economic weakness to allow market yields to decline from where we are today, both in the U.S. and we think abroad.
How have you shifted your stance as the economic data has come in stronger than expected, given that so many people are pushing out their expectations for recession, if we even get one?
Yeah, so the big shift that we've seen really is that we've grown much more comfortable with duration risk. Anytime we see the 10-year above 4%, we think that's an attractive area to add duration to portfolios. We ultimately think high-quality duration is going to be a very good hedge if in case we're wrong and it's a more severe downturn than just a mild recession / soft landing next year. That long, high-quality duration is going to be really a very attractive hedge versus risk assets. At the same time, as we sit here this summer, given where risk premiums have gone, spreads have tightened, the attractiveness of the credit sectors has certainly declined a bit. So we are actually kind of reducing our exposure there, thinking that there'll be some better entry points as we move through the year. So we're moving closer to what we would call the midpoint of our risk budget here and staying up in quality to reflect that slowing in economic growth that we're expecting, some increase in defaults as we move through the balance of this year in our portfolios.
Interesting. Tony, thank you, sir. Tony Rodriguez there of Nuveen on the credit market. I had this conversation with Peter Cheer yesterday, and I wish Pete was on a panel with Tony because Peter Cheer thinks we're in the summer sweet spot, thinks the juice is worth the squeeze, maybe take on a little bit more risk through the rest of this summer. And there you've got Tony Rodriguez talking about the same sweet spot, but ultimately using it as an opportunity to trim risk and prepare for opportunities later this year.
Get the outcome right and you'll still get two different trades. And I think that's a great way of putting just the uncertainty, not only in what's going to happen, but how you play it out through markets that have really defied logic in some capacities, or at least traditional stuff.
How do you feel about the BOJ this morning? Starting gun on tightening or just making easing more sustainable?
Both, right? Because they're making easing more sustainable by relaxing their hold just a bit. How much of what we saw from the Fed and the ECB gave them the license to do this? Because you had a less aggressive policy there, it would be less disruptive for them to make some sort of shift. And maybe that's why they saw an opening this week.
If they made the move when government bonds were selling off aggressively and the tightening cycles had just started from the ECB and the Fed. It's an interesting point. Live from New York City this morning. Good morning. Welcome to the program. On the S&P 500, we are positive by 0.5%. Coming up a little bit later, 8:30 a.m. Eastern Time, so about 40 minutes from now, Jonathan Pingle, the chief U.S. economist at UBS, to break down the strong data we've seen so far this week. And Lisa, more data still to come later this morning.
You know, here's the issue, and I've really been confused about this week. What data is going to matter? How do we translate it? Is it going to be Procter & Gamble showing that they can raise prices? Is it the fact that NASDAQ 100 companies are no longer mentioning recession? They're all mentioning artificial intelligence and the boom that it's going to create for their earnings and pricing power. Or are we going to look at these lagging indicators that have proved faulty in the past, right? I mean, at what point, what is the actual indicator that's going to give us a sense of what direction central banks are going to move in?
You get a break in the Goldilocks story. Max Kentner of HSBC has been tremendous, hasn't he, over the last 18 months? And Max talks about that Goldilocks moment where the economy's not too hot, it's just right, just encouraging this idea of a soft landing. But to Torsten Slok's point this morning at Apollo, for markets to get that ultimate nirvana outcome, you don't want a re-acceleration. Don't want a re-acceleration. And we're seeing in certain parts of this economy a re-acceleration.
The housing market, to me, is the key right now also, because you do see a bottoming out and a re-acceleration in that area. And if that is the leading indicator in terms of interest rate-sensitive sectors, what's that saying about supply and demand, about price tolerance, about the efficaciousness of the idea of a 7% mortgage rate? Nah, who cares if no one's paying it?
We've got to talk about this FX market as well. Jane Foley of Rabobank joining us in about 5 minutes' time. Really looking forward to catching up with Jane after the moves we've seen from the Bank of Japan this week, together with the ECB and the Federal Reserve. To the heart of foreign exchange very shortly from New York City. Good morning.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. One of the biggest names in business choose Bloomberg.
That is a great question.
It's a great question.
Great question.
Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
They don't think they've beaten disinflation. They don't think they've got growth. You know, they've moved up short-term inflation forecast, left along what long-term ones.
So is this not a step towards normalization then, as no, he said it wasn't?
It isn't really. Well, it's an indication that they know that yield curve control is a bad policy that needs to go, and it's an indication that they're cognizant of the fact that actually the economy is doing better than it was. So it'll take months to get the next move. Ultimately, yield curve control is a terrible policy.
Well said, Kit Jukes, the head of FX strategy over at SocGen, catching up with Danny Berger on Bloomberg. The early edition a little bit earlier on this morning. Looking at the FX market, dollar yen is lower for 5 consecutive sessions every day so far this week. Yen strength against the US dollar. On the week, that currency pair is negative about 1.85%. So tons of yen strength out there off the back of this move from the BOJ, loosening its grip on bond yields. Jane Foley of Rabobank saying this, that the BOJ tweaked YCC in, quote, a very cautious way. As expected, the BOJ raised its 2023 inflation forecast, but there was no upward revision to core CPI in 24 or 25. Therein lies the reason for continued caution from the Bank of Japan. If further progress is made in reviving domestically driven inflation, the BOJ will act again, but they are clearly in no rush. So, Jane, we've got to start with that question. Lisa's asked it a few times, and Danny Berger asked it again this morning. And, Jane, thanks for being with us. Is this the starting gun on tightening, or just setting up policy to keep things a little bit more sustainable and easier for longer?
You know, the starting gun really reminds me of the tortoise and the hare, and I think the
Bank of Japan really is the tortoise in this race. It is going to be in no rush. And this is, backing away from yield curve control, because it can be a nuisance sort of policy. It can push policymakers into corners. And we had this in December when the Bank of Japan, made an adjustment to the range for the 10-year yield and said it was an adjustment. Now, clearly, we can see those distortions. You have the possibility where you have maybe 5-year yields, 7-year yields rising above the 10-year yield. That's not what they want to signal. So they had to raise the parameters. And really, I think there's something about what's happened today, which is the same. They want to take themselves away from being pushed into a corner by market conditions and hence the loosening. But on the other hand, if you read through a lot of the rhetoric from some of the Bank of Japan policymakers, some of them are clearly seeing these signs that inflationary conditions are just beginning to normalize. And I would say perhaps, the real piece of juicy news from Japan, this week is that the government looks likely to be recommending another hike in the minimum wages. That would be a 4% hike. There was already, a really big rise this year. So if that 4% goes through, that is your wheels in motion of domestically generated inflation. That's what they want to see. That's the sort of news that we really ought to be reacting to.
So, Jane, that long-term forecast for inflation that comes from the Bank of Japan, should I view that as an honest view on where they think inflation will be, or just a signal to the market for where they want the market to believe policy will be?
Well, the government came out with a pretty similar forecast for core CPI. I think it was 1.5% for the next fiscal year, stripping out, some of the base effects because there have been some energy-related subsidies, for instance. So again, the government, the Bank of Japan, lots of economists are on the same page here. They think inflation next year will be lower than this year. And that is why they've got to be cautious, because we've got to remember a lot of the inflation that we are seeing, people are saying, Bank of Japan or Japanese inflation on the headline is firmer than in the US. Maybe they should be tightening, but that is really misleading, because a lot of the inflation in that particular print is imported prices. Now, imported prices are not domestically driven. That's what they want to see. It's the opposite, really, to Europe, to the Bank of England, to the US. They want to see this wage price spiral, getting themselves up to sustained inflation around about 2%. We're on that road, but they're not quite there yet.
Is it a coincidence, Jane, that the Bank of Japan's tweak, I should say, comes after a real shift from both the Fed and the ECB moving away from forward guidance and away from committing to further rate hikes?
Well, I think the moving away from forward guidance sort of reflects the fact that the committees within those central banks are perhaps, there's bigger gaps between the doves and the hawks, because if everyone was on the same page, it's obviously easier to give forward guidance. But when you have this more diverse range of opinions, you can't really do that. And I think that's probably true of the Bank of Japan as well. I think there is a range of opinions within the Bank of Japan. If you read through some of their rhetoric, some of those policymakers are perhaps more ready to act on policy than others. But, a caution has always prevailed through the Bank of Japan because of its history with deflation and disinflation. And I think that is still here. And I think that's very evident in the commentary this morning from the Bank of Japan governor.
It hasn't just been the Bank of Japan that's been causing some waves. This week, there seems to be a feeling that both the Fed and the ECB may be done with rate hikes, which calls into question whether the ECB actually will end up hiking further than the Fed this year, which was the consensus heading into 2023. What's your view on this? Do we have to rethink this, that maybe both are at their peak and the rate hiking cycle over in Europe isn't going to be as long as many people thought it might be?
Yeah, we're coming down on the view that they may pause in September, that there may not be any more moves from the ECB. Some of the commentary from some of the officials from the ECB in the last couple of weeks, has been mixed. But there have been some comments indicating that perhaps core inflation could be plateauing, because obviously that's the focus for Europe, this core inflation, this stickiness there. But if we look at some of the economic data, for instance, those PMIs that we had for Europe at the start of the week, they were really quite worrying. If we saw, the credit credit survey from the ECB too this week, well, that showed that the higher interest rates are clearly impacting. So there are, recession is hanging above Europe. Germany, of course, already in recession. Recession risks are really very real, and that may give the ECB cause for constraint in September and pause policy. So we are data dependent. We have to make up, our minds on that according to the data. But there is certainly a risk that the market is going into the possibility of a pause in September whilst it's long the euro. And that's really important because I think positioning here is going to be adjusted. And I think the market has got very long the euro and anticipated with a very high hawkish ECB. And that might have been, overdone.
All favourite trades. Let's wrap up. Jane, downside on the euro. What is it?
Well, we've had, for a while now, a 3-month forecast for euro-dollar at 108. A few weeks ago, I think people, wouldn't have agreed with that. I think now maybe people are coming round to that. The market is very long the euro, and I think it's increasingly difficult to see that situation being justified. Jane,
thank you for getting on board with the programme this morning following that breaking news from the Bank of Japan. Appreciate it. Jane Foley of Rabobank responding to the latest headlines out of the BOJ and the week that was. The Federal Reserve, the ECB with a focus on Europe. Here's a focus on America. Andrew Hollenhorst over at Citi, writing this just moments ago, just echoing what he's been talking about for a number of weeks now. Strong growth and softer inflation look like a soft landing, but we doubt the Goldilocks conditions, Lisa, can last for more than a couple of months. It's that summer sweet spot commentary all over again.
And how you interpret it depends really on who you are and where you're coming from, what your longer term framework is. Andrew Hollenhorst seeing a pickup in inflation, pointing to the employment cost index, saying that it'll come out probably in about a half an hour now, saying that labor costs are just rising too quickly to get to some sort of immaculate disinflation. Again, okay, so if we get an ECA, if we get a surprise to the upside, does the market sell off? Is that a huge market mover in an increasingly data-dependent Fed?
Current output numbers, current labour market figures, inconsistent with the return to 2%. Most people assume something's got to give. Or the Fed just tolerates something higher, right, and just pushes out the timeline to get back towards that 2% line in the sand.
My theory that is very subtle and unspoken, so this is going to be first. I think people still believe in the immaculate disinflation. People still believe in the pandemic effects that are going to shake themselves out have just taken a really long time. And so they're expecting the year-over-year comps to just come down and to return to a low inflation, low growth world because of aging populations and because of the overhang of debt. And that's a presiding sort of sentiment that is driving this sort of feeling that we're going to get to another place that is very, very familiar.
We'll get there in 2025, according to the chairman. Can you imagine if back in 2021, when they were playing the transitory game, that they said transitory is 4 years, we'll be back there in 2025, and for that reason we see no rush, no reason to hike rates aggressively? Because there are some people who believe that the tightening cycle of the last 12 months hasn't even bitten yet, that the deceleration we've had in inflation has nothing to do with what we've seen from the Federal Reserve.
That it's just simply the year-over-year comps, and this is the disinflation post-pandemic. Key to watch the University of Michigan sentiment survey, which I know you love, but in particular, the longer-term expectations of inflation, not just this survey, but in general. The longer it takes, is that when you start to see inflation expectations creep up in the market and among consumers?
I just want them to call me. That's it.
Public service announcement. If you are on the University of Michigan polling center,
the other end of the questions,
call Mr. Jonathan Farrow with
where
his
do you
Tide
see
Pods
long-term inflation
stacked up in a perfect neat
I just
line.
want to contribute to the survey. I want to be one of the 600. Isn't it a minimum of 5? Is it 500 or 600 people?
You should say, I believe inflation is going to be 3.1269.
No, I'd go with a crazy number.
That's why they're not going to call you.
Yeah.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders
around us to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Quantitative tightening is really kicking in now.
Parts of the economy are definitely feeling the strain from higher interest rates.
The pace of this cycle is very different than everything that we've seen before.
This cycle is aiming to finish up sometime in the fall.
Soft landing, the market sniffed that out sometime in June. Earnings, though, thus far have been pretty confirmatory of that outcome.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We should do what the Europeans do. Vacation for a month. Didn't you feel that from Lagarde yesterday? It was like, we're done and we'll see you after the summer.
I love this. You're not even subtle about it. You're lobbying the central bankers, basically. Why even show up to anything?
Shut the market for like 30 days. Everyone goes away for August. Beautiful thing. From New York City this morning. Good morning. Good morning. It's my reason and my purpose in life in New York City is just to convert America to the European view.
How's it going?
On vacation. It's going really well. Where's TK?
Exactly. I was about to say.
TK's on vacation. There you go. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market on the S&P 500 positive by 0.5%. Wrapping up a monster week of central bank decisions and earnings as well. And a little bit of breaking news from a central bank where a week or so ago we didn't expect it to come from. The BOJ, Lisa.
They tweaked their policy to allow some flexibility in the upward limit of the band, allowing 10-year treasuries or 10-year JGBs rather to trade at a slightly higher yield. I should say trade in quotes because it's unclear who's trading them. But here's the question. How long can we see a calm in markets that yesterday seemed a bit jittery on the heels of rumors of this, but the actual delivery of it has really landed with this incredible finesse.
You know what? A journalist should actually do that. Go find that one person
100%
that traded BOJs, JGBs, like a week ago.
I was actually thinking about that. Maybe they could call the three people who actually trade JGBs.
Who trade with the BOJ.
Exactly. And just say to them, okay, what's the word? What are you going to do with this? What's your interpretation? Because that predicted everything.
The market.
At least.
Half the market. We've sort of lost perspective on what's happened over the last 10 years, and you wrote about it extensively. We have a central bank that owns half of the government bond market in Japan, who has set a limit for how high yields can go, which essentially is setting a limit on borrowing costs for the Japanese government at 0.5%. And they've come out this morning and we're talking about it as breaking news. Just to reset the conversation. Imagine someone's tuned in to this program for the first time ever. Welcome. And you're trying to explain to them that this country exists, a developed country, that is buying pretty much all of the JGBs, all of the government bonds, and capping interest rates at 0.5%. And we're sitting here and saying it's news that they might tolerate maybe a breach of that level and perhaps come in when it gets to 1%.
Right.
And that's like this monster move, because relative to the last 10 years, apparently that's introducing just this little bit of market discipline back to the Japanese government bond market.
To take it even a step further, they've also been buying stocks through the ETF purchases. So it's not just bonds. They've owned an entire market. So why should we care? Well, for a number of years, people said if they abandon this on the heels of inflation that Japan is seeing as well, that could disrupt all of markets and send yields in developed markets surging higher as people move back to the Japanese market and buy JGBs. What we've seen this morning on the heels of this tiny maybe move, maybe not, they're saying it's not a move, we're seeing calm, and some people are saying this might give them the freedom to go even further.
Do you want some good news out of Germany?
Of course.
It's not the growth story, it's the inflation story, and this is what sounds like good news in Germany these days. 6.5% CPI. That's a downside surprise, by the way, month on month and on year over year. EU harmonised year over year. 6.5% CPI, Lisa, out of Germany.
I can just hear the cheering. I mean, great. It's good. It came a little bit in below expectations, although if you take a look at consumer prices in line, 0.3% month over month, as you were saying. So are we seeing victory here that basically a slowdown in economic growth does lead necessarily to a slowdown in inflation? Or does this just give you a sense that this is, I don't want to say the sick dog of Europe, but right now kind of the economy that's doing the worst among all of them?
Describe the dynamic. 0% growth, 6.5% inflation. What is it called?
Stagflation.
Right. Did that come up in the news conference yesterday at the ECB?
Did not, no.
Why not?
Partly because it's Germany, so she's not going to address a specific nation. But you're right. Why can't you say, how difficult is it for you at a time where Germany is in stagflation to be creating a policy that also deals with a real growth picture and inflation in both France and Spain?
Just totally obsessed with the next move. I was really disappointed with the news conference of both the Federal Reserve and of the ECB, the obsession with September, just the absolute obsession with September. Because many of the questions in those news conferences are asked with the purpose of trying to get some headline that moves markets. And you can see every individual in there trying to achieve it. So they consistently ask about September.
It's a great point, rather than try to understand the theory that they're following.
Totally.
In order to decide whether or not they need to further rate hikes.
And can I just say, Mike McKee's the exception he always is.
100%.
Because Mike's a great friend of ours. Steve Chevron joins us now, Head of Multi-Asset Solutions at Federated Hermes. Steve, wonderful to catch up with you. You mentioned the pain trade in this equity market may well be a higher equity market. Just walk us through it, Steve.
Yeah, I mean, it's been the thesis that we started with in January when we went back overweight, which was that, look, even if recession risks do materialize at some point, and that's still an open question, it's not today and tomorrow doesn't look good, John. I mean, you look out, if you're still in a position of tight labor markets, inflation that's sticky, a Fed that, at best is maybe pausing, may still be in the hike cycle. We'll see what September and November bring. But is certainly not anywhere near, a place where they're cutting. Historically, that's not an environment where you have big equity sell-offs. If you look, Fed pauses are really good for equity markets. 15% returns on average, 20% max rallies, drawdowns that are relatively small. And so I think that you're in this scenario, and I heard you mention in the prior segment this idea of a kind of summer window. I don't think it's a summer window. I think this goes higher for longer, and I'm talking about equity markets right now. So we see upside through the old highs, even if storm clouds do eventually, materialize. But we don't think it's soon. So,
Steve, upside where? Because people are willing, or at least want to, shift away from the tech winners. They want to think about maybe the things that are left behind, cyclicals, banks, energy, take your pick. Steve, how are you thinking about that?
Yeah, so again, if you look at both Fed pauses and then even once you get into Fed cuts, cyclicals tend to do better than your kind of defensive growth names. Also, a 27 times multiple for the Russell 1000 value. That's hard for us to kind of just hold our nose and buy. So what we're buying is everything else, pretty much. So we've been overweight value, particularly cyclicals and the defensive dividend payers, a little bit as a hedge. And then our newest buying has been in small cap growth. The idea is that it entered its sell-off a year before. Those names are still down 20% on a 2-year basis. And while valuations look high on an absolute basis relative to where they were 2 years ago, we think they're attractive. So if there's any disruption to the kind of big tech and growth names, it's going to be those smaller companies we think that emerge. And we just think that offers a much better kind of upside scenario. So it's really cyclicals. Yes, a little bit of those defensive dividend payers, but then also the small cap growth where we think there's some better opportunities.
I want to point to something that Torsten Slok wrote that John was talking about earlier of Apollo, where he wrote, for markets to continue to trade higher, the soft landing must be a soft landing, not a reacceleration. And he's speaking, of course, about inflation. How much does your bullish call hinge on inflation not reaccelerating and continuing to go down?
Yeah. So, in the list of things that you need to watch, I'd put that in there. You've gotten the housing market. And home prices have shown some signs of reacceleration. I know we've all seen some of the labor deals that have come through. We're watching wages. Our expectation is that you will see some reacceleration in at least a headline number in the back half of the year. That's just math, Lisa. I mean, your toughest comps or your easiest comps, depending on how you want to think about it, were really in the first half of last year. As you get to the back half, just the base effect should take you up. So we still have a 3.9% core CPI forecast for this year. If it was materially higher than that, and we're talking about a Fed then that is forced into, much more aggressive policy action, again, that could have some disruption. But if you look, there has never been a market in the last 40 years, an S&P 500, that was negative during the hike cycle. There was never a market except for one that was negative during the pause cycle. And so it really is, once that economic data has deteriorated and you're in a cut cycle, that you start to worry about those big downsides. But it's hard to see us in that scenario in 23. And that's the story, that if you're a soft landing person or you're someone who sees a kind of new bullish trend here, being overweight equities obviously makes sense. Even if you're someone that's cautious, though, the historical track record suggests that for some time, and not a very short period of time, you probably still have upside risk, at least through the old highs.
When do you know it's gone, Steve, the upside risk or the upside potential for some of the risk assets?
Yeah, I think what you watch and what we're watching are going to be spreads. Spreads are one. When you start to see spreads move up, I think you need to see a little bit more deterioration in initial jobless claims. You've got to at least get to that 300,000 level before you can start to really think about a material deceleration in the labor force. The unemployment rate would need to kind of creep up on the back of that. The yield curve, not just being inverted, but starting to re-steepen would be a sign. If you start seeing that yield curve get back towards zero, historically, that's a sign that that's starting to happen. Bond yields that are falling. You get the theme here. Those are all the things that I think the most bearish folks thought would be happening already. And granted, even though we saw a first half rally, I might have expected to see more progress in that direction so far this year, but it hasn't happened. And so until it does, you've got to stick with the regime that you're in.
Stick with it. Steve, that's the message. Thank you, sir. Steve Cheverone of Federated Hermes on this sweet spot in the market that he thinks can last a whole lot longer than many others do. This just in from the Bank of England. Here's one. The Court of the Bank of England is pleased to announce that Dr. Ben Bernanke has agreed to lead a review into the bank's forecasting and related processes during times of significant uncertainty. Lisa, I think this is the Bank of England basically undergoing a review after getting the inflation call so wrong. And they're not alone, of course, but interested to see a central bank conduct this kind of review and getting someone on the outside like Ben Bernanke to come in.
Trying to get the credibility and to retain the confidence of its independence at a time when a lot of people are questioning how some of these central banks could get things so wrong. I do wonder who's next, right? Could you see the Fed getting some sort of external board of former Bank of England members to discuss what they potentially could have gotten wrong with transitory inflation?
Sure. I think we need a big committee, don't we, with the people who got it right for a start. And I'm not sure that was Ben Bernanke.
There is that too.
Right? Couldn't they have tapped someone on the shoulder that got it right?
Well,
okay.
Who did?
Mohamed Al-Arian.
Okay, that's true. I thought you meant central bankers. Yes, that's true.
No, I mean, you can pick an outside external economist who got it right and come in and have a chat. But it's one for another day. From New York City, welcome to the program. Your equity market positive on the S&P 500. On the NASDAQ as well, on the S&P positive by 0.56%. Jonathan Pingler, UBS, coming up very shortly following the latest US economic data. The employment cost index is just around the corner. But Lisa, don't you agree that if you're going to tap someone to do a review, tap the person or people who got the call right on inflation and what went into their forecast, their thinking, what process did they go through that enabled them to come up with a completely different view to the consensus on your committee?
Mohamed Al-Arian, if you're watching right now, if you would like to be tapped on the shoulder, please let us know.
For himself. I'm not going to speak for
I'm
Mohamed.
just kidding. Yes, no, I understand.
You want that external influence to come in. I think there's something to be said about that. But then you tap sort of that establishment figure that was very much with the consensus on where inflation was going to be.
It's an important point. How do you gain credibility at a time where people are worried about groupthink in some of the central banking institutions, where there is a feeling that everyone needs to get on the same page? And if they do have a different view, they're often pilloried in public opinion in the economics profession. So how do you get the sense in the public that this is an independent body, one that does have the credibility of independent thought, not just that groupthink?
Bloomberg subscriber just moments ago, so this is not my view, it's theirs. The bloke who printed the money to cause inflation to review the problems caused by printing the money that caused inflation. That's one view. Other people might push back, of course. Henrietta Trays of Vader Partners in Washington, up next.
City, in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Powell was pretty confusing. He wanted to assert very strongly that every decision is, every meeting is live, that every meeting is made based on the data. But in fact, there seemed to be guiding us to a slower pace of policy. That sounds like a committee that is, number one, divided, and number two, pretty close to the end.
Such a thoughtful guy. Vince Reinhardt there, the chief economist and macro strategist at Dreyfus and Mellon, on the latest from Chairman Powell, and responding to the economic data just yesterday with Lisa following GDP and jobless claims. Later this morning, about 13 minutes away, the Employment Cost Index, the next big one to watch, the ECI, as it's called. Labour market pressures, what do they look like? And do we see further deceleration in wage growth, that kind of disinflationary theme that's breathed some life, some oxygen into the soft landing hopes and dreams of this equity market? Your equity market this morning, a lift on the S&P 500, up by 0.56%, on the NASDAQ, up by a little bit more. It's been quite a week for the economic data and for the earnings as well. In the bond market, yields lower by 4 basis points, 395.26. Yields lower on a day that things have been shaken up just a little bit at the BOJ, but as we've repeated this morning a few times, Lisa, this because we had the strong lead from Nikkei's reporting about what would probably come this morning from the Bank of Japan.
And that lead was a bit more aggressive than the actual move itself. But as you've mentioned several times today, it's still too early to write the book on what this looks like, because it's also too early to understand what exactly they're going to be doing. The proof is in the pudding of how this stuff trades, if it trades, but whether it actually does end up with the yields going materially above the band.
You say if it trades, and I think it's worth just sort of fleshing that out just a little bit. There are days in the Japanese government bond market, market, a term we use loosely here, where nothing trades, where the Japanese 10-year does not trade at all.
Well, and this is the conundrum. Why trade something and make a bet when you could have a whale that will come and crush you and will decide, I don't like that. That doesn't work for me. Boom, I'm just going to snuff that out. And that really is the reason why we might not even get that big of a move, because it's unclear exactly how far this Bank of Japan will actually do.
Where's the line in the sand? Is it at 60 basis points? Is it up closer to 1%? And I guess maybe we'll find out. Joining us now, down in Washington, Henrietta Trace, the Director of Economic Policy Research at Vader Partners. Henrietta, wonderful to hear from you, to have you on the program. You know the story of the week. It's been about the age of Washington, D.C. What is anyone going to do about it, if anything at all?
Right. I mean, unfortunately, I don't think it's a particularly new story. We've experienced this as far back as I can remember, and certainly before then. I think one of the things investors are really trying to get a handle on right now is, if there is a vacancy, how fast is the seat filled? What does this have any immediate impact on? Are we still going to see legislation push through as we get into September? And I would point to the Appropriations Committee, which in the Senate has, 51-49 split, as bipartisan as you can get. And they have pushed all 12 appropriations bills out of the committee for the first time since 2018. So I think that even split is weirdly helping in the Senate at this point. And if a few members are no longer in office and they will be replaced with members of their same party, you will keep that same sort of status quo of a very slim Democratic majority, Republican minority. And the biggest change would just be in sort of directional leadership, since we are talking about the minority leader, Mitch McConnell, who has been the leader of the Republican Party for the longest of any Republican serving in that role. So I think the leadership direction is also really interesting. Is he continuing to, give Speaker McCarthy free rein? Would leadership continue to support Tim Scott for president over Donald Trump? Those leadership decisions for the party at whole, which are so different in the Senate versus, say, the House or even the Republican Party far-right fringes or the support of President Trump, those supporters, it's a marked difference. And I think whoever replaced McConnell, if he needed to be out of office, would be someone who would try to continue those things, but it'd be difficult because McConnell has really done a differentiated job on that run.
How are you expecting this issue to shape the campaign in the next 18 months, particularly for the Republicans next month in that first debate, when someone like Nikki Haley has already put this out there and asked for so-called competency tests from leaders in Washington?
It's not the first time we've seen somebody ask for a competency test for leaders in Washington. You could even say competency tests for voters. I don't think any of that is going to move. The threshold for support is just way too high. So you'll hear that argument. Unfortunately, it does span both political parties. You do have very elderly leaders in both sides. So it somewhat negates the argument since everybody is doing it. So obviously, it's a frequent refrain we hear against President Biden or really many of the leaders. And both sides of the aisle, Republicans and Democrats, have very old members in the House and the Senate.
There are a lot of people who say one reason this has persisted is because voters don't care and they continue to vote for people regardless, and they take a priority on the idea of name recognition and years of service over a new entrant. What is the impact of that on younger voters? Are we seeing any sort of shifts there, or is it pretty much status quo?
It really is much more obvious to see the changes based off of what a candidate votes for, not their age. And we could use the last election as an example. Name recognition is humongous. Chuck Grassley has incredible name recognition in his home state, and it's unlikely that he would ever be defeated, if for no other reason than that, despite what he's given to his constituents. But I would say that the number one piece that you're looking for is for younger voters is a focus on things like abortion and climate change, and it doesn't matter how old you are if you're able to get those things right. And then you have President Biden working on student loan forgiveness. That's obviously a youth voter and supported initiative, and that is where Biden gets his support despite his age. So it's really on those three issues: climate change, abortion, and student loan issues, things like that. That voters tend to flock to if they are a younger voter, and the older voters would focus more on immigration. The economy is always top focus. For Democrats and democracy now, democracy actually polls as the second highest important issue for voters across the board right now, which is a really interesting argument. And in some circles that's anti-MAGA, in other circles that's anti the Biden administration. So those issues are really invigorating voters.
Henrietta, sorry, I've got to jump in. We're now saying that democracy issues are both anti-MAGA and anti-Biden. Can you explain that? How is democracy anti one party or the other?
And both.
Sure. It's a morning consult poll that they do like every week. It's fascinating to watch the trends, and that's what I focus on a lot. And the economy is persistently the number one issue, right? Everybody always says that. Then the second issue is this vague sort of democracy. And I want to apologize. I think it's actually a Quinnipiac poll that does that. So democracy, the value of your vote, the ability that you have to go vote, all issues that Donald Trump railed against. Both before and after his election, things like mail-in balloting. Those are all sort of democracy issues that you could have an issue with the Democratic Party on. And then on the left, you look at things like the insurrection, the special investigations that are occurring right now. The indictment of President Trump today is going to be on election issues and democracy. Did he try to take away the rights of American voters to actually vote? Did he try to nullify their votes with Vice President Pence, et cetera? So both sides of the aisle have a way to say that democracy is critical to them, and it polls as number 2 in some polls.
Amazing.
Issues.
Henrietta, Thank you. Henrietta Trace there of Vader Partners. Amazing, isn't it? How divided things are across things like that.
Tribal politics. That's what this has become. And the other side is destroying the fabric of the nation. That has been basically the feeling on both sides. And so what do you get where you can come together and actually talk about issues and things that people can agree on and have common ground?
That would be nice, wouldn't it?
It would be really nice, but it wouldn't really,
unfortunately,
sell in the same kind of way.
No, that's not politics.
Exactly.
Right now. Coming up, there'll be plenty of that on the Open in about 35 minutes. Just people throwing stuff at each other about markets. Monica Defend of Amundi. Jim Carron of Morgan Stanley, very aggressive chap. Cameron Dawson of New Edge Wealth.
Oh, yeah.
All of that and more.
Tribalized markets.
That's a beautiful line. Tribalized markets on Bloomberg TV and radio. From New York, equities positive. We're almost there. You can hear it in my voice, can't you?
No.
We're a few hours away from the weekend. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1, so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Just moments away from a slew of U.S. economic data, including the employment cost index, a sense of just how hot or perhaps cooling the U.S. labor market is and how much wages are rising, as well as personal income and spending. Also, the PCE deflator. This is the key metric that the Fed watches to understand the direction of inflation in markets. Not a whole lot of drama. Gains in the equity markets, a bit of a retracement from yields going higher yesterday on the heels of that Nikkei report, talking about the Bank of Japan eliminating yield curve control. Didn't quite do that. We've been talking about that this morning. Right now, the data is coming in. We're joined by Michael McKee of Bloomberg. Mike, what do you see?
Well, we got some big numbers this morning that are important. We've got the employment cost index coming in a little bit lighter than anticipated and down from the prior quarter. It comes in at 1%, down from 1.2% in the first quarter, which would be good news for the Fed. We'll get the breakdown on that and see what the wage component was in just a moment. Personal income rises 0.3. That's a little less than last month's 0.4, and down from the 0.5 to 0.5% that was anticipated. Actually, the May number was revised up to 0.5%. So slowing there, but we did see that in the overall GDP numbers. Spending comes in at, as I said, 0.5%. Real personal spending at 0.4. So not a huge inflation effect. And then those PCE numbers that everybody from Lisa to Jay Powell are watching. The deflator comes in, the headline number comes in at 0.2%. That's a little bit faster than last month, but it was what was forecast. And so on a year-over-year basis, headline PCE is 3%. The core is 2%, 0.2 gain. So that comes in at 4.1%, and that's lower than anticipated and certainly lower than 4.6% last month. So, Lisa, we've got basically the same story we've had for much of this week. The data come in line kind of with what the Fed wants. Not all perfect, but better than it has been.
Suggesting a slowdown in inflation while retaining some of the strength of consumer spending and growth. The market reaction isn't that significant based on the trend that this just continues. Stocks just edge slightly higher. The NASDAQ leading the way up more than 1%. You can see 2-year yields just edge slightly lower in response to this, currently at 4.85%. You could see the euro dollar, which has been moving all over the place, and there had been a bit of dollar strength and then people reassessing. We don't see a huge shift there. A euro strength, dollar weakness, that continues with a 0.4% gain. Mike, when I'm looking through these numbers, it does seem to confirm this Goldilocks scenario of slowing growth, slowing inflation, but still robust consumer spending. How reliable, how significant is this data showing an upside surprise of personal spending, even even as incomes fall off just a touch.
Well, it's kind of what the story we've been seeing. It is interesting that we get a little bit of an upside surprise in personal spending because the GDP numbers suggested consumer spending had fallen off. So maybe that was weakness in April and May, and June comes in better, which sets you up for a little bit better spending going into this third quarter. And obviously, we've got back to school coming up, which will be an important measure for retailers. The other numbers that come in better than expected, they're not going to have a huge impact right now because we get a lot of data between now and the next Fed meeting, but it does show that things are going in the right direction. And so maybe Jay Powell gets the board of governors together and they'll go out for happy hour today or something.
Well, or they just go take August off, as Jonathan has been talking about all morning. Mike, please stay close. And as you look through the data, we will get more details in just a little bit. We have with us someone who has been at the Fed who might tell us about happy hour after getting good economic reads. Jonathan Pinkel, chief U.S. economist at UBS, who is not at happy hour currently, sitting at his office. I'm curious from your vantage point, Jonathan, how much conviction you can have in this soft landing narrative when we keep getting data print after data print showing, disinflation, robust growth, this feeling that maybe we will just immaculately get price stability.
Yeah, I mean, this is certainly good news, but we're still actually a long way from price stability. I mean, I think, looking at today's employment cost index data, as sort of Mike was saying, as well as the core PC deflator, the year-over-year change falling to 4.1% puts the Fed actually within striking distance, 0.2 of their sort of full year projection for later this year. But even at 4% or the Fed's 3.9 in Q4, you're still a ways away from what you would call price stability. So everything looks great now. I mean, looking at, Mike was mentioning real spending coming in a little stronger. We'd actually sort of expected the 0.4 increase, and he's right. I mean, we ended up revising up our Q3 consumption estimates after retail sales as a result. So this is all good news, and the economy has certainly proved resilient. But they do have this problem that we're making progress on inflation, it looks like, but we're not actually at 2 yet, and there's actually a pretty big gap between now and how we're going to get there, and a lot of uncertainty. But at the moment, Lisa, yeah, the data looks good.
What's the bigger risk right now? That we're wrong about inflation just steadily coming down and we see a reignition of some of the price increases, or that the economy slows down more dramatically and that the strength that we've seen recently perhaps isn't indicative of the longer term trend?
Well, I am pretty worried that this economy is going to slow meaningfully in the coming quarters. There are a lot of positives right now, but there are also headwinds. And I still kind of agree with Chair Powell that there's still follow through from the monetary policy tightening. I think there's still excess savings that's percolating through and supporting spending. And some of these forces could diminish. We also have things like student loan repayments coming up. I mean, there's a number of headwinds and challenges that we're still going to have to face as an economy. But I think you've nailed the sort of risks on the head, right? Because everybody, of course, would like to have a soft landing and not have job loss and have this continue. But the initial conditions are a little tough. And by initial conditions, I mean, we're starting with a low unemployment rate. Even with the ECI at 1%, I mean, I think that's going to be great news at the Fed, take a little bit of the wind out of the sails of the more work to do component of the committee. But that's still a little over, it's 4% annualized, and the Fed kind of needs it to get it down closer to 3.5. So we've got a low unemployment rate, nominal wage inflation that's still a little brisk. If the economy stays strong, there is the risk that the Fed might have to hike more and do more work to get the slowing that they need in the economy.
A lot of people, Jonathan, have been talking about how it's been easier to get a disinflationary trend just simply on the year-over-year comparison numbers, at least over the past few months. What changes? What areas of the inflation overview are you looking at? Is it housing? Is it car prices? Is it something else that could fuel some sort of strengthening in the inflation reads?
Well, I mean, it's all of that. I mean, I don't think the details of the inflation data in my career have ever been as looked at as they are today because of how crucial it's been for monetary policy. But when we think about, sort of what's unfolding in the various chunks of the basket, I mean, I think, there's people have talked about, super core and sort of these measures. I mean, I don't want to put a label on it, but when we look at some of the services components that are most linked to wage inflation, many of them also have relatively persistent components. I think we can get comfortable with the goods disinflation and we can see it. And I think, we're watching sort of, OER and rents slow and the CPI data. But, these other services, are really sort of what I think is worth watching for where the improvement could come, or what might reaccelerate because of the low unemployment rate. And that's one of the reasons I think Chair Powell in his press conference went ahead and mentioned the ECI as sort of one important data point they would get between the July and September FOMC meetings.
And if you're just joining us now, we did see the ECI, the Employment Cost Index, come in at 1% for the second quarter. The expectation had been 1.1%. It was down from 1.2%. Personal spending coming in stronger than expected at 0.5%. Personal income coming in softer, so people making less and spending more. Michael McKee, you've been digging under the numbers. What do you see?
Yeah, let's look under the hood at a couple of things that Jonathan was talking about. The ECI for wages goes down to a 1% gain from a 1.2% gain in the first quarter. And that would be considered reasonably good news. But then when you look under the personal income figures, wages went up 0.6% in the month of June. And that is up from 0.5%. It is actually the highest increase since January. So we have two sort of contrasting views of what wage pressures are doing at the moment. And John mentioned, as we do every time we get an inflation figure, the super core, which is Jay Powell's favorite thing. Core services ex housing comes in at a 0.2 gain, 0.22 if you want to round it out to three figures, and that puts it at a 4.1% increase for the year, which is going to be your lowest since basically last August. So things moving in the supercore direction. Take out housing out of the equation, and services for the PCE, like the CPI, are down. But the wage numbers still healthy, and that suggests consumers can still keep spending. The question is, will the Fed see that as inflationary?
Jonathan, as we talk about these numbers, 4.1%, down significantly from what it had been, from 4.6% the previous reading. When's it enough? Are we heading back toward 2%? Or, to the conversation we had with Richard Clarida, are we looking at a 2.5% or something somewhat above the target that the Fed's just going to live with?
Well, I mean, so this is a question they're going to have to answer at some point, I think, next year. At the moment, obviously the 4.1 is not enough. I do think it's pretty relevant, though, for sort of the meeting by meeting decisions they're going to make going forward. I mean, at 4.1%, they're only 0.2 percentage points away from their full year core inflation projection already in the June data. So they're clearly making some progress. The other thing they're making progress on is real rates. This is going to widen the gap between the funds rate after the rate hike on Wednesday to a level that hasn't been around since 2007. So they're making progress in terms of restrictiveness, not just because of the rate hikes now, but also because they're making progress on inflation. Now, a year from now, let's say inflation's moving down to 2.5%, they're going to have to make a decision about how hard they push to get it back down to 2.0. I mean, I do think that monetary policymakers would like to actually get it back to 2.0 for their credibility, to show that they can do it. Are they going to really work very hard to run it at 1.8 so that they can show that they're on both sides? I don't know that that's worth really costing a lot of people their jobs, but I do think they're going to leave, if they're struggling to get back to their target, I think they probably would leave restrictive policy in place for a while.
Jonathan Pingle of UBS, thank you so much for taking the time. If you're just joining the program, right now we are seeing a bit of a rebound in the S&P, in the NASDAQ, the S&P 4593 up 0.6%. What we are looking at right now is economic data that's supposed to matter so much more. And still with me is Michael McKee, our Bloomberg economics correspondent. Which data matters if we have this increasingly data-dependent Fed, an increasingly data-dependent ECB? Okay, well, the market's not moving too much on the heels of this. When's it going to matter?
Well, it's not going to really matter until you get into September because we have the August data. Well, we've got all the July data yet to come. We start next week with the ISM and the jobs numbers, and then you get the September jobs numbers. You get August jobs numbers in September, and we get more CPI numbers in August, more PCE numbers. The Fed's going to have a lot of data between now and then that could change. Right now, the situation looks pretty good, which is why I'm expecting Jay Powell to be buying at the happy hour this afternoon. But when you look at the inflation numbers, they're moving in the right direction, which is what they want to see. And interestingly enough, and maybe this will we'll have to get a breakdown from John Farrell once the markets open about goods, whether we're seeing consumer staples rise or something like that, because goods spending rose faster than services spending.
Interesting.
According to the government in the month of June.
Yeah, well, Hermes earnings came in better than expected because of Birkin bags that were going up at a pretty significant pace.
Tom was spending on.
Yeah, exactly. Which I'm saying it like the investment manager. Coming up, we're going to be talking about the real estate market. Danielle Hale of Realtor.com will be joining us. Michael McKee, thank you so much.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will
rate hikes and being very, very data dependent in terms of being concerned about inflation. And if they see it, they're going to act. And one of the points that I like to make is that, for the ECB, for example, people are starting to count them out and say, look, they might have one more hike and that's it. But I kind of take a different view on that. I think the ECB, out of all the central banks, has to get the inflation problem solved. And that's because of the structural rigidities in the European labor markets. So what Europe is starting to experience right now is a small form, just the beginning stages of possibly wage price spiral inflation, meaning that you see a lot of strikes in Europe. People are getting higher wages. Companies are able to increase their prices. People get higher wages, and on and on and on. And that's a spiral. So I think that it's more likely that the ECB can overshoot. Now, to that point, and same with the Fed. I think the Fed is also very, very concerned about keeping inflation anchored. So to that point, I think that whether it's Powell or it's Lagarde at the ECB, I think that the door is still wide open for them to continue to hike interest rates. So I think front-end yields can be somewhat at risk. Curves are likely to stay inverted. Not until they start steepening will I believe that the end of the rate hiking cycle is really here.
Jim, would you expect to see some divergence between government bond markets in Europe, in the United States, based on the information you're seeing so far? The French GDP data, and we'll talk about it later, was okay. Germany's terrible. The PMIs earlier this week, not great at all. I just got this note from Bank of America, Mike Gaither and the team, and the headline reads, if this is a slowdown, please give us more. Because the data in America, Jim, has been pretty decent through the week. Could we get some divergence between government bond markets?
Absolutely. Look, I mean, I think that the data is even diverging to some degree. And the way that I've looked at the U.S. versus Europe since the pandemic is that the U.S. has been running about 3 or 4 months ahead of Europe in terms of the cyclical data and the turning points and central bank policy and inflation and things like that. So I think that the surge that we're seeing in the U.S. right now, this late cycle surge, Europe might actually see that too. And I also think that PMIs, particularly in the U.S., are bottoming at this point, and that they're going to move more towards services as opposed to services moving to PMIs.
Wow.
Services moving to manufacturing. And I think that that's going to happen in Europe as well, but it might not be until the early part of next year.
Jim, thank you, buddy. You're going to stick with us. Jim Karen, Monica Defend on the latest economic data as well. We'll talk about that in Europe in just a moment. Just bear that in mind, that in the United States, and in Europe for that matter as well, the theme has been that services have been up here, pretty decent data, manufacturing down here, pretty ugly. And a conversation we've been having, how do they converge? Services down to manufacturing or manufacturing up to services? Jay Pilowski at TBW earlier this morning on Bloomberg Surveillance suggesting it's in the more constructive way. Manufacturing recovers, and you're hearing something similar from Jim Karen there. Your equity market right now on the S&P 500 positive by 0.7%. The opening bell about 20 minutes away. Down in Washington, some breaking news in the last, I would say, 5 or 10 minutes. I want to head down to Bloomberg's Anne-Marie to get those headlines for you. Anne-Marie, what's the latest?
What we know is Senator Mitch McConnell plans to stay on as the Senate Minority Leader to lead the Republicans on the Senate side. Jonathan, there's been a lot of speculation and concern regarding his health. Remember, he had a concussion. He was out for a few months. He came back, and then yesterday, while on camera, while speaking to reporters, having this press conference, he froze for 20 seconds, and he was lost for words, and he was escorted away. Then he did come back and address reporters, and then later when he spoke to reporters, he did a very political, interesting maneuver, turning it on the Democrats, saying their president of the United States also dealing with potentially some issues. He said, the president called me. I told him I was in great health, but that I got sandbagged. So what we're learning from CNN, Jonathan, is he plans to serve the rest of the 118th Congress as the GOP leader. The one thing that's interesting about this statement that CNN is publishing is that the statement does not address his plans in the next Congress, which begins in 2025. He is still going to be an elected official from Kentucky at that time, but the statement does not address his plans for 2025. So this is certainly one that we'll be watching.
MH, thank you. We'll be watching that through this morning as well. We'll touch base with you in about 30 minutes' time. The president addressing the United States on the economy and economic policy a little bit later on this afternoon. We'll get you a preview of that a little bit later. Equities then higher on both the S&P and on the NASDAQ with some movers. Here's Abby.
John, let's take a look at some of the upside movers helping futures climb this morning after yesterday's bit of a drop. Intel up the last time I looked up more than 6%. They put up a profit, 6.7%. They put up a profit instead of a loss in the last quarter, a 3% revenue beat. The biggest deal, though, is that they are saying the PC slump, the personal PC slump is over, and the second half should be better. and they gave a bullish guide for the current quarter. Advanced Micro Devices up 1.7%. Now, they're a competitor, of course, to Intel. They report next Tuesday, but they're getting a little bit of a sympathy lift here. Plus, they did announce today that they're making a $400 million investment in India. And then finally, Reata Pharmaceuticals absolutely soaring, up 52%. The biopharma firm is soaring on Biogen taking it over a bid at $7.3 billion. It will bolster its portfolio of treatments for neuromuscular and rare diseases. The share price $172.50. The stock not so far below it, suggesting investors think it may get done.
Abby, thanks for that. We'll touch base with you around the opening bell. Coming up, more signs of economic divergence.
Inflation has been high everywhere, including US and Euro area, but really the primary drivers have been quite different. In the US, it's really coming from a very strong domestic economy. It's just more of a challenge in the Euro area to get us back to a steady state.
That conversation up next.
I don't think we can replicate Tesla. Tesla is unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but X-Pen is X-Pen. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The near-term economic outlook for the euro area has deteriorated, owing largely to weaker domestic demand. High inflation and tighter financing conditions are dampening spending.
The broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures.
It is a tale of two recoveries, US inflation cooling and consumers remaining resilient, adding to momentum in the economy ahead of the third quarter. This as the data continues to raise concerns over in Europe. Germany just about exiting recession, but its outlook remains gloomy and manufacturing weak. Let's get to the team coverage. Bloomberg's Enda Curran in DC alongside Maria Tadeo in Brussels. Maria, how mixed are things in the Eurozone economy right now?
Well, they are, and that's a challenge for a central bank that obviously has to set monetary policy for 20 different economies. And I think you see that today in the data that we got from both Germany and France. These are the two biggest economies, so obviously we really look at them in detail. You had a huge beat from the French economy for Q2. You also had inflation, by the way, cooling down the most since the war started. When you look at the German situation, they're out of a technical recession at this point, but the outlook continues to be very, very difficult for this economy. A lot of this because
because of the industry and just this perfect storm that they've had for a year now. Also, I should also stress the data that we got today, and again, it points to this divergence perhaps between a more service economy and a more industrial economy. It is backwards looking. So we know that the European Central Bank will focus on the data from now until September. We also had a taste of it yesterday with Madame Lagarde saying there is an outlook that could probably deteriorate in the next few months. So that is really going to weigh in on this. So the data today, yes, to set the scene, but will it be crucial for the European Central Bank going into September? Probably not. They want to look into the future.
It's pretty mixed over in Europe right now. Ender, I have to say in the United States, it looks pretty robust, doesn't it?
Yeah, the US was supposed to be in a recession by now, John. That was the narrative back in January. But as you know, the numbers keep coming in pretty well. GDP data yesterday showing pretty decent pace of growth for the economy. Underlying that, we know consumer spending is holding up. We know inflation is headed in the right direction. We saw some more detail on that this morning with the wages data showing increases just coming off moderately there. We know that investment in manufacturing is going gangbusters. There are, of course, soft patches within manufacturing, but the electronic vehicle space and battery space and the whole industrial policy story is driving a lot of demand there. And so we know the US economy is in good order. That said, though, you know, there's a risk of getting too giddy about it in some respects as well, John, because the months ahead will tell just how far the labour market will soften. Will inflation continue to moderate the way the Fed is hoping, or will there be a bit of a sting in the tail as we get later into the year? I mean, it's fair to say that the soft landing story is very much the story of the day, but this inflation chapter isn't yet over, I think. Something that Citi's Andrew Hollenhurst keeps talking about, Ender, repeatedly, that maybe the data over the next month or so might look like a soft landing, but the data later this year, he's expecting it to look a little bit different. And Karen there, Maria Tadeo on the latest. I've been talking about this over the last day or so, that what you heard from Chairman Powell and President Lagarde might sound the same, but the underlying economies are very, very different right now. Jim Karen, this came from Capital Economics moments ago. It said Q2 resilience unlikely to last, talking about Europe, but inflation is here to stay high. Now, Jim, why aren't we talking about stagflation in Europe when that's what increasingly it looks like?
I think that's the direction that we're headed in, effectively, right? So the ECB is in a very, very difficult position where they have some of the traditional economic data starting to fall, but inflation is staying sticky. And this is what I was referring to before, where there are different structural rigidities within Europe that are different than what's in the U.S. And I think a lot of it has to do with labor and the labor force. So the U.S. labor force tends to be a little bit more dynamic and robust. U.S. companies can upsize and downsize labor as needed relative to the economic cycle. In Europe, they have a lot more difficulty doing that. So as wage prices go up, that's like a form of permanence. If the economy starts to turn down, that starts to squeeze profit margins in companies, and this just becomes a lot more of a difficult situation for the European economy as a whole. So I do think that we are heading into some stagflationary pressures in the euro area. We also have to recognize that Europe is also tied a little bit more to China in terms of their economic activity versus the U.S. So those factors, the structural rigidities, the tied levels to China, are differences between the Eurozone economy and the U.S. economy.
Monica, Chairman Powell is hoping for a soft landing. Are there reasons to hope that President Lagarde doesn't end up in some kind of stagflationary quagmire?
Well, the U.S. economy has been extremely resilient and definitely well above our expectations. And even also the corporate earnings, despite variable, has been quite robust and resilient. And all the profit margin squeeze that we were expecting actually did not materialize, if not on specific sectors. So when it goes to our own projection, we expect the U.S. economy to slow down, mainly via tightening financing conditions that have not been reflected fully yet in the real economy, but should eventually hamper the U.S. consumers that, as I was saying before, still on with a positive sign, but real consumption is slowing down in the last over the second quarter, and the tighter financing conditions should also eventually hurt the small and medium enterprises. So overall, there will be a slowdown. How deep and when it will start to mark a recession that is still open. But the soft landing scenario is what we have in mind right now.
Jim, just to finish on Europe, if you end up in some kind of stagflationary state, how do bonds trade against that, Jim? Is that good or bad?
Well, I think it's more of a shape of the yield curve story. So what it tells you is that the curve probably stays relatively inverted, which is not good for the financial sector or the banks, because the ECB probably has to continue to hike rates, and that's going to put pressure on the front end. But then the markets are basically going to say, yeah, but eventually we're going to have a slowdown in a recession, and it's going to be a little bit longer lasting. So longer term bond yields end up staying relatively well bid and with lower yields. So you end up with an inverted yield curve, which is generally not a good economic indicator for the future. And that probably also, heightens some of the risk of a slowdown.
Hey, Jim, thank you. Jim Caron alongside Monica Defend there on the latest in this market. The central bank trilogy of the week, the BOJ, the ECB, the Federal Reserve. We need to talk about this equity market, up today by 0.7%. Coming up, the morning calls and later, New Edge Wealth's Cameron Dawson saying the market's AI obsession is starting to crack. The opportunities outside of big tech, that conversation about 7 minutes away.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Minutes away from the opening bow. Look at that move on the NASDAQ. Futures up, up, up and away. Firmer here. Let's get you some morning calls. Deutsche Bank downgrading Southwest the hold, expecting limited upside following the airline's quarterly results. JP Morgan upgrading New York Community Bank to overweight, seeing an attractive risk reward with growing market share gains. That stock is up by 3.4%. And finally, Bank of America upgrading First Solar to buy, highlighting solid bookings momentum and the company's improving execution. That stock is up by almost 13% in early trading. Up next on this program, New Edge Wealth's Cameron Dawson expecting the equity rally to start broadening out. The case for looking outside of big tech coming up very shortly. Your equity market positive by 0.66% on the S&P 500 and the NASDAQ 100 a whole lot higher. The opening bell just around the corner.
important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
23 seconds away from the opening bow this morning, this Friday, getting you towards the weekend. Your equity market positive by 0.7% on the S&P, on the NASDAQ up by more than 1%. About a week away, some big earnings from Apple and Amazon after some pretty big gains so far year to date. There's the opening bow this Friday morning. Good morning. Switch at the board and get to the bond market. Yields look like this on a 10-year, lower by a couple of basis points. Your 10-year this morning, 397.46. Yields higher yesterday off the back of better than expected economic data. And the rumour mill in full drive after that Nikkei report suggesting the BOJ would do exactly what it would do, which was tweak yield curve control. This morning, yields pulled back in the FX market. The euro trying to find some strength, just about 110 right now. Euro dollar positive 0.2%. Crude just short of 80, $79.60, down 50 cents on the session. We're down 0.6%. About 30 seconds into this session right now, your equity market more broadly on the S&P 500 advancing 0.7%. On the NASDAQ up by 1 full percentage point. Two stocks to watch at the open, Exxon and Chevron. Shares under pressure after posting monster declines in quarterly profit. The Exxon CEO saying this: the work we've been doing to improve our profitability is reflected in our results, which doubled from what we earned just 5 years ago. Abby has more. Hey, Abby.
Well, John, their profit, though, is down 50% from a year ago, so I think that's what's probably worrying investors to some degree. It's interesting, though, to see the shares of Chevron trading lower than Exxon, given the fact that they beat both top and bottom line estimates. Exxon did beat revenue estimates, but their profit, not only was it down 50% year over year, it missed slightly. So this is a margin problem. Both of these companies, or at least Exxon, is talking about the possibility, or not the possibility, the actuality of downstream or refining margin pressures, that it's costing more. Now, it's interesting because the conference call is going on, and one analyst asked the CFO about the upstream, could there be issues? And it sounds as though the fourth quarter, that some of the pricing pressure that we've seen recently, that really hasn't quite factored in. They're just starting to see that now. So will analysts be revising estimates down? It's completely unclear right now, but it sounds as though there could be possibly some issues ahead around that. But one bright spot, both of these companies, they're doing very well in the Permian Basin, John.
Abby, thank you. The latest on Exxon and Chevron down by 6 or 0.7%. Let's stick with results. Intel delivers a surprise profit and bullish forecast. The CEO says we continue to execute on our strategic priorities and building momentum with our businesses. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, well, Intel declared an end to the slump in personal computers demand, and actually it has the numbers to back it up. It was a beat and raise quarter for this chip maker. It posted a surprise profit, and it paired that with a bullish sales forecast that topped analyst estimates. Specifically, Specifically, sales in the third quarter expected to come in as much as $13.9 billion. That compares to an average analyst estimate of about $13.3 billion, so higher than expectations. And Intel really needed this, given that the sluggish demands for PC chips up until this point, it really battered the business over the past year or so. And you add in CEO Pat Gelsinger's comments that Intel remains on track to meet its target of regaining manufacturing leadership by 2025. And you can see that shares currently up about 4% at this moment, had been higher by as much as 8% pre-market.
Katie, thanks for that. The stock is higher, as Katie indicated. Let's turn to Ford, pushing back plans to ramp up its EV production. The CEO, Jim Farley, telling analysts, clearly this transition to EVs is dynamic. The pricing pressure has dramatically increased in just the last 60 days. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. There's a lot of data to pass, but the story is pretty clear. The losses from EVs are deepening, and the timeline to ramping up production to higher volumes is getting more distant. So losses this year for the EV business will now be $4.5 billion US. They had previously said it would be $3 billion. Model E, the unit which manufactures the electric vehicles as a standalone business, had a loss of $1.08 billion in the quarter just gone. The other data point is that Ford's aim of an annual production of 600,000 units battery electric will not happen in 2023. They are now saying it will happen in 2024. So they're pushing that timeline out. Pricing is a really key point here. What Ford is saying is that the first wave of early adopters is gone. They have their EVs, and the average consumer is not willing to pay that higher price point. That's what the CFO, John Lawler, was talking about, them not seeing the top line growth in electric vehicles that perhaps they'd expected. So what do we see? Well, a lot of price pressure, and a lot of the intensity of that price pressure, according to Jim Farley, the CEO, has come in just the last 60 days, cutting prices to be more competitive against Tesla. Interestingly, though, the broader business is quite healthy, and this was the headline immediately after the market closed when the numbers dropped. They raised guidance for adjusted EBIT this year higher because, of course, they still have the legacy combustion engine business, and there is demand there and performance there as well.
Did we hear the same thing from GM?
Yeah, it's interesting. You look at the sell-side reaction to Ford, and they said the bar for Ford going into this was so high because of the results that GM posted. But both of them are in the same boat, right? Transitioning the business from a combustion engine to EV, selling both, but also having to cut prices to basically target what is the remaining demand. The early adopters are gone. The average American or global consumer doesn't want to pay $75,000 for a car.
That stock's down by 3%. Let's push ahead to next week. I know you're covering earnings from the likes of the big tech players, Apple, Amazon as well. What are you looking for from those names next week?
Well, I'm also kind of smiling at relief that they're not all on the same day this quarter, because that can be brutal for me. But I think that we basically want to use them as a proxy for the consumer. You know, Prime Day for Amazon is always a bit of a misleading indicator because they always break their own record. But it doesn't give you a good sense of the health of that business. Also, cloud gives you the barometer for corporate demand and corporate spending. AI is a big part of that story. Apple, maybe we get some early indication of the Vision Pro, but it's all about the iPhone globally and some sense of what the global consumer is doing with a microscope on China, John.
Ed, if you had to grade it so far, looking at Meta, looking at Alphabet, it's been a pretty good week, hasn't it?
Been a pretty good week, but read Alex Barinka's Tech Daily newsletter. AI is all the hype we're talking about. You actually look at the reaction on the sell side, some of the buying. I think that actually there's still a lot of faith in the fundamentals of these businesses. Strong balance sheets, demand for their product or services, even in a weaker economic environment. They have staying power because of what they're able to offer and their global reach.
Looking forward to the show a little bit later, 12 Eastern Time. Ed Ludlow alongside Caroline Hyde on Bloomberg Technology. Let's turn back to the market. Big tech leading stocks towards a third consecutive week of gains. Our next guest, though, says it could be the laggards that start leading the way. New Edge Wealth's Cameron Dawson saying this: we're seeing the everything else rally. Better economic growth should mean broader participation, especially from the economically sensitive sectors that have been left behind. I'm pleased to say that Cameron Dawson joins us now. So Cameron, let's start there. What has been left behind?
Yeah, what we've seen this year is, of course, that really narrow leadership within tech. And what you've seen is that there's been laggards in economically sensitive parts of the market. So things like energy, industrials to start the year. But really, since June, you've started to see some of those areas perk up as economic data continue to come in better than expected. So if we are to see this more resilient economic data, we would expect broader participation in the equity rally, meaning that those areas that are cyclically sensitive should start to do better. And it also is important to point out that these are the areas that have seen the least amount of PE expansion or multiple expansion. So there's more room for those multiples to adjust to a better economic reality compared to the technology stocks and growth stocks that have already re-rated back up to their 2021 peaks.
As you indicated, the economic data has improved. Cameron, any evidence that earnings estimates have gone along with it?
This has been really peculiar this quarter, is that we continue to see economic data come in better than expected. We see it with economic surprises. We see companies beat and raise estimates. And yet, if you look at the full year estimate for 2023 earnings, they have inched down just slightly, which means that analysts are effectively cutting numbers for the back half of the year. So that does create a scenario where we have a low bar for earnings in the back half of 2023. But then we'd note is that what that also creates is even more growth expected in 2024. You have about 11-12% growth already baked in for 2024. And a lot of that is margin expansion, which would bring you back to peak margins back that we saw back in 2021. So that's one area where we would watch that maybe estimates are a little bit too high. But in the near term, it does seem that estimates are too low for the economic reality.
Just on pricing power, just briefly, Kimberly-Clark, Procter & Gamble, volumes dropping off, but revenue growth because prices are able to increase and the tolerance still seems to be there. Do you expect that consumer price tolerance to last much longer?
Well, it is a really good question because as we continue to see kind of stronger goods demand as well, look at the personal consumption data today. Instead of it being led by services, it was actually led by goods. Goods were much stronger than services, even despite this turn in higher prices. So for now, consumers are accepting it. We're seeing a little bit of give back on volume, but Procter & Gamble this morning raised prices by 9% and only had volumes drop by 3%. That's pretty incredible and is a key reason why margins have been so resilient for these businesses and why revenue growth has remained so strong.
About 10 minutes into the session, the NASDAQ outperforming. We're advancing here by 1.2% on the NASDAQ. If you are just tuning in, the S&P 500 higher by 0.75%. Cameron, I remember a note that you put out in the last couple of weeks, and it was bull, bear, or duck. For the people that haven't read that, haven't heard you talk about it, what is a duck?
A duck is a market that goes sideways, but there's a lot of activity happening under the surface, meaning that if we do see this rotation away from some of the leaders this year, this idea that maybe tech digests some of its recent gains as it hits that peak in valuation, but you do see a recovery in some of these areas that have been left behind, those rotations under the surface could mean that there's lots of opportunity for price changes, but the overall index doesn't move very far, just meaning that we've kind of hit a ceiling on broader valuation, but there's still lots of room for rotation underneath, which is one of the ways that we've been playing this market since the beginning of June, buying equal weight, looking for areas that are trading at discounts in order to take advantage of the rotation. So a duck market seems smooth on the surface, but lots of activity underneath.
Where do the small caps fit into that?
Small caps are still extraordinarily sensitive to interest rates. I think that this is one of the key headwinds for small caps is that they are less profitable. You still have about 45% of companies within the small cap Russell 2000 index still not turning a profit, even in this economic environment. And they tend to have more floating rate debt, which just means that higher interest rates actually bite small caps compared to large cap companies, which have had the opportunity to term out their debt, essentially make them agnostic to current interest rate levels, and really being able to be resilient even in an economy where you see the Fed raising rates so much. So our view on small caps is that you see these pockets and spikes of recovery, but you're unlikely to see a sustained rally and sustained period of outperformance until we start the next cycle, which just means that small caps typically do best at the beginning of an economic cycle when the Fed is easing policy rapidly and they're kind of rebounding from that near death as you went into the recession. So small caps, we think you still have to remain very high quality simply because of high interest rates and that economic sensitivity.
Hey, Cameron, thanks for that. Enjoy the weekend. Let's catch up soon. Cameron Dawson there of New Edge on the latest. Thank you. The broader market about 12 minutes into the session, advancing by 0.8% on the S&P. Nice, pretty decent outperformance on the NASDAQ going into a big week for the NASDAQ 100. Some big weightings there for you. Apple and Amazon next Thursday. Up next on this program, the president promoting his economic agenda ahead of next week's jobs report.
There are two parts to Bidenomics. The first part is just explaining what's going on and claiming credit for what is a pretty strong economy, inflation aside, and that's a big aside. The second part about Bidenomics is to talk about some of the president's legislative achievements.
The president heading to Maine to discuss Bidenomics. That conversation up next. We'll catch up with Anne-Marie and Mike McKee.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt and local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar-weakening trend means companies in emerging markets should have more room for growth. And countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
There are two parts to Bidenomics. The first part is just explaining what's going on and claiming credit for what is a pretty strong economy, inflation aside, and that's a big aside. The second part about Bidenomics is to talk about some of the president's legislative achievements, which collectively amount to this big pro-growth agenda that he got through a divided Congress. So it's both about claiming credit and then explaining sort of the rationale for all the legislations.
Everything's been amazing, inflation aside, as he said. That's a big aside. President Biden preparing to discuss his economic agenda following a string of better-than-expected data. The White House saying this. The president will discuss how Bidenomics is driving a manufacturing boom and helping workers and innovators invent and make more in America. Bloomberg's Anne-Marie has more. Hey, Anne-Marie.
Hey, John. Well, today you can expect a fresh installment of Bidenomics with a focus, as you mentioned, on manufacturing. For the first time in his presidency, the Biden will be heading to Maine. He'll be giving this speech on manufacturing at a factory, and his message is going to be behind those strong economic data points is that his plans are working. One of those points he's likely going to mention today is that investment in manufacturing construction has had its single largest contribution to the nation's economic growth in more than 4 decades. The issue the president is facing, Jonathan, and we talk about this a lot, and actually our reporting is that he's been frustrated with aides around him, is that the message is not landing. The American people are still not feeling that the economy around them, even if the data is showing that it is doing better, that it actually is doing better. They can't feel it. So that's the message the president wants to bring to Maine today. Another interesting point, Jonathan, about this factory, it recently won a legal battle with a Chinese competitor. So broadly, Biden is also potentially going to talk about competition with China and how that plays into his larger economic plan.
Any sign that's resonating with voters, Anne-Marie?
Well, I'm not sure that's resonating with voters at the moment because we're here from both sides of the aisle that everyone wants to talk tough on China, right, Jonathan? So I think voters get it from all sides when it comes to China. I think it's really going to come down to how people feel about their household income, about their disposable income, about their job and growth prospects when it comes down to November in 2024. I think they're less focused on competition with China and more focused on how much am I paying for groceries and what's the gasoline price today.
And that gasoline price is going the wrong way all over again, more recently anyway.
Yeah.
Anne-Marie, thank you. AMH down in Washington, D.C. That address by the president, 1:15 Eastern time. If you want to pay some attention to that, we will be here at Bloomberg. Looking ahead to next week, a payrolls report just around the corner. Mike McKee back with us for more. Mike, what can we expect?
Well, it's going to be a very busy week, Jonathan. It's the first week of the month, and that's always the week we get the big numbers. We start off with one last day of July, and we get the Senior Loan Officer Survey on Monday. Remember that? The Fed chairman talked about it. He said it's going to come in as expected, so we think there'll be some tightening there. Tuesday, you've got ISM manufacturing and JOLTS. Wednesday's ADP. Thursday, productivity, jobless claims, ISM services, and then Friday is Jobs Day. And in terms of the Jobs Day numbers, we are expecting a slowdown. We've been expecting a slowdown for months and months and months, and it doesn't seem to happen. 190,000 jobs is the forecast at the moment. That'll change as we go through these numbers next week, and economists get a better view of what's happening. But unemployment not supposed to go up, and average hourly earnings supposed to go down just a little bit. So if Joe Biden were giving this speech and we got these numbers a week from now, he'd still have some good news to talk about, and we'll see if that is indeed the case.
I imagine he won't be talking about the ISM Services Index, Mike. Wall Street will be. There is a survey of services activity next week. Mike, Jim Karen of Morgan Stanley was on the program earlier this morning, and he was talking about that divergence, the divide that we talk about, you and I, between manufacturing and services, and he thinks the manufacturing can converge up to services. What are you seeing more recently in those surveys?
Well, what we saw last week or earlier this week, the S&P PMIs, manufacturing did improve a little bit. Services did decline a little bit, but services are still above 50. So if manufacturing moves up to where services are in the ISM version of these PMIs, then it's going to be good news for the economy. And I think we pointed out earlier on the show that goods spending was faster than services spending in the month of June. So maybe things are turning around a little bit.
A very little sign of Fed speak on the calendar, Mike. Have you noticed that?
It's just beginning to fill in. We're going to hear on Monday from Raphael Bostic and later in the week from Tom Barkin. And so I imagine it will pick up, but they're all going to go on vacation. Wait till Jackson Hole. That's when we'll
That's
hear
what we should do, Mike. We'll take a month off and we'll reconvene.
I'd like that.
Jackson Hole,
I'd talk to the boss about that.
I'd love that too. TK's going to cover. Tom's very adamant about the American philosophy of work and no vacation, so TK's going to be here, taking over things. Mike McKee, thank you. Looking ahead to the Senior Loan Officer Opinion Survey, SLOOS, a sign of its time, really, in many ways. It's like the inflation hysteria of the last couple of years. Hysteria because it was legitimate. Let's be clear about that. But also the fact we were looking at you, Mitch, inflation expectations during that time, and now we're not really. And the Senior Loan Officer Opinion Survey, well, that was all about the bank intention of 2-3 months ago, and now hardly anyone's paying attention to it. It comes out, as Mike indicated, on Monday, by the way. Let's get you some sector price action. We can do that with Abby.
John, we have a very robust day for the S&P 500, the best in basically a month. So not surprisingly, most sectors are higher, led, in fact, by the heavyweight tech sectors, communication services, consumer discretionary, information technology, all up more than 1%. We also have staples, a defensive sector, interestingly enough, up more than 1%. To the downside, energy and healthcare. Energy, of course, dragged on by Chevron and Exxon. As for the week, well, it's going to depend on today. Basically, what today does will determine the S&P 500's direction. So right now, we are looking at a gain. The best sector right there, the communication services index, up 6.5%. Its best week since March 17th. Of course, on Alphabet and Meta and those blowout results and the stocks reacting to the upside.
Appy, thank you. Advancing again this morning. Your trading diary up next.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The sun is shining on this economy, this market right now, that's for sure. The data's been decent, the earnings have been okay. Chairman Powell appears to give the impression that he's willing to back away. And equities are up by another 0.8% on the S&P. The NASDAQ's positive by 1.5%. Next week, huge week for earnings. We'll talk about that in just a moment. That's the price action. Let's get to the trading diary. President Biden promoting his economic agenda from Maine this afternoon at 1:15 Eastern Time. Then we get ISM manufacturing numbers next Tuesday. More tech earnings from Qualcomm on Wednesday, Apple and Amazon earning results on Thursday, plus ISM services and a Bank of England rate decision coming up a little bit later next week too. And finally, the US payrolls report this time next week on Friday. From New York City, that does it for me. Enjoy the weekend. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture down.
The BOK is getting ready to make this decision.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, July 28th. Here are the top market stories we are following for you at this hour. Curveball. The BOJ makes the surprise move on curve control by loosening its grip on bond yields, jolting markets in the process. The Japanese 10-year yield hits the highest since 2014. Intel in the clear. Shares surge after the chipmaker delivers an unexpected profit, gives a bullish forecast, and declares an end to the PC slump. And mind the data. PCE data shows cooling in inflation while consumer spending picks up. UMich consumer sentiment figures are dropping now. From Washington, I'm Kaylee Lyons with my co-host in London, Danny Berger. Alex Steele and Guy Johnson are off today. Welcome to Bloomberg Markets. Danny, happy Friday. And as I mentioned, we have some data to get to.
Happy Friday, Kaylee. That's right. As you say, UMich numbers coming in. This is the final reading, and we're seeing some slight tweaks to the preliminary reading. Not massive. Maybe the one to look out for is 5 to 10-year inflation that has been revised slightly, and it was at 3.1%, Kaylee. It's now just at 3%. Otherwise, sentiment, both expectations and current conditions have come in. Sentiment was at 72.6 at 71.6. So inflation comes in a little bit, Kaylee, but so do expectations. Perhaps good news for the Fed?
Yeah, maybe. It certainly doesn't seem like it's good or bad news for the market at this point. Not seeing too much reaction in Treasury yields. Right now, the 10-year yield is down by just about 3 basis points. Of course, though, we have seen Treasuries whipsawed in the last 24 hours by news out of Japan. First, the Nikkei report that the BOJ was considering a tweak to curve control, and then the Bank of Japan actually did it. It does look posed to be making changes to its yield curve control program, which, of course, it first introduced in 2016. We can see here the reaction on Japanese bond yields, that big jump in the 10-year GGB after they announced they would allow it to rise above that 0.5% level. Joining us now for more is Bloomberg's Enda Curran. So, Enda, can we call this a shock? Is it a shock? Or was it a shock yesterday when the Nikkei report came out?
Definitely a surprise anyway. Markets seem to have recovered a bit on it this morning. Look, they are effectively doubling this yield band that they have been pursuing over recent years. But the bigger story, leaving aside the technicalities, is that they are trying now to move away from this program of yield curve control. It has outlived its purpose. Japan is obviously moving on. They're dealing with inflation at the moment, for example. Governor Ueda is trying to stress it's not a tightening. He doesn't want to exit the supportive policies that he have, but it's going to be harder to sell that message now when it's expected he will really exit this over the coming months.
Right. I find it quite remarkable that the market quickly moved on to focus on other things, focus on, barely softer PCE data we had this morning. Is it job well done then? I'm assuming Ueda didn't want to cause any sort of market rupture today, and
Exactly, Danny. He really wants to take this carefully. But you saw the initial reaction when the Nikkei news came out. People were quite surprised by it, and you saw the response. But I think the BOJ will be comfortable with where they're at. They know they need to take this very carefully. Governor Ueda has said several times he doesn't want to trigger big financial market volatility in Japan. Remember, Japanese investors, they're big buyers of U.S. government bonds, big buyers of securities and real assets right around
to keep GDP yields at very, very low levels and have successfully kept GDP yields at very low levels. It has come at the cost of very significant interventions. Japan, in this case, the Bank of Japan owns more than 50% of all JGBs outstanding. So in some sense, it was unsustainable to continue yield curve control. So it's not only because inflation is very high that is the reason for this tweak or change. It is also that there's very little liquidity in JGB markets, and their ownership had gotten up to very high levels compared to other central banks. And because of that, one step at a time. But the clear issue here is that step is certainly in the direction of allowing JGB yields to move higher.
Are we going to look back at this, Torsten, and say this was a very elegant way to exit YCC, to kind of smooth out the upward trajectory instead of having any pop in yields?
Yeah, so at least widening one step at a time is probably the best approach that you can have. But let's think about it from the broader perspective. I mean, inflation has gone up globally. The Fed has raised rates, the ECB has raised rates, Bank of Canada, Australia, the Bank of England, everyone has raised rates. The Bank of Japan has done very little. In fact, today is the first move that we're seeing in response to high inflation. So if that's the case, then from that perspective, the Bank of Japan is just following along what other central banks are doing. So to your good question about how is this going to be viewed, if we look at it from a longer term perspective, this will likely be viewed as a major day in US and Japanese fixed income markets, because it does signal the end of the 7 years where yield curve control has been in place. And yes, we may get more widening further out, but the consequences are clear that Japanese investors will now be looking, and they already have expensive hedging costs for when they buy US fixed income. But when they roll these hedges, then they will probably be looking at US fixed income with different eyes now that yields in JGB markets will be going higher.
Okay, so if that is happening simultaneously, Torsten, with potentially the last hike of the rate hiking cycle for the Fed in the rear view. In theory, they haven't indicated that they are going to go in September. How do those two forces collide, that Japan is doing this while the Fed is slowing things down in a material way?
Yeah, it's a really important question because, I mean, think about it. The Fed is trying to tighten financial conditions. They are doing that by raising rates. That has been countered by a bull run in equities and in credit. So that has been easing financial conditions and therefore offsetting what's been happening with the Fed funds rate. So interestingly enough, what has been happening here with exiting yield curve control, or at least widening the band, is indeed a tightening in financial conditions that therefore actually helps the Fed in this process of trying to slow the economy down with the ultimate goal of slowing inflation down. So yes, it is a collision of forces that's very important. The question is, of course, how manageable and how much this will be over time. And if we do see over the weeks ahead still more drifting higher in long rates, then that will, of course, help the Fed's goal of trying to slow the economy and ultimately slow inflation down. But that's why it's so difficult to exit a policy that you had for 7 years in an easy and smooth and gradual way. So let's see where this goes. But for now, it's, of course, pretty clear that it's been pretty volatile over the last 24 hours.
Especially a policy that's forced you to own half of the bond market, Torsten. They also downgraded their 2024 inflation expectation to below the target of 2%. Do you buy that? Do you think Japan will be there in 2024?
Well, a lot of that also depends on a number of different things. Of course, global growth, and importantly also what will happen to the yen. Interestingly enough, of course, as you know, that if you do see Japanese yields go up, that will then attract more money into Japan, which will create an yen appreciation. And an appreciation in the yen is holding down Japanese inflation. So therefore, exiting yield curve control is actually helping the BOJ in terms of putting downward pressure on inflation through import prices or through the yen appreciating. So I do think that we will see now some impact on Japanese economic activity, and we should also expect to see some impact on Japanese inflation. But the magnitude of this, and likewise, like the debate we have in the US, can this be done in a smooth way where we get a smooth landing or a soft landing, or will this also run the risk that we get a harder landing because yields just simply go up too much and they have to intervene again when we get up to now the upper end of this new band? It will be a very exciting time ahead of us for currencies and for fixed income because it has so many unknown factors in terms of what would the response be, in particular of big investors in Japan, to seeing yields in their own backyard start to move higher.
All right, just when I thought things were exciting enough. Torsten Slok of Apollo, thank you so much for joining us. Have a great weekend. Coming up, we're going to get more on this question of the day. Torsten thinks it's a tide change. Is it? Or is it a tweak? Kristen McLeod of Barclays will join us next with her take. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Markets Japan are tinkerers in this, and he seems like a willing to tinker at the margin, sort of a football coach who changes his team every game and or formations twice in a game. Can't leave it alone. And that's not necessarily a bad thing. I think to say that you're unpredictable, the market says he's pretty clear in his communications.
That was Kit Juke, SocGen Chief FX Strategist, speaking earlier to Danny on Bloomberg Television, which brings us back to our question of the day. The BOJ's move overnight, was it a tweak or a tide change? Joining us now is Kristen McLeod, Barclays co-head of Global FX Distribution and head of America's Macro Distribution. So, Kristen, what do you think? What exactly did the BOJ do here?
Well, I think the BOJ wants us to think it's a tweak. But the reality is there's little doubt that this is the first step towards policy normalization. If we take a step back, I think, this has been a stunning turn of events. By most measures, the communication that we've heard from the BOJ, from sources, from officials over the past month, in many respects has been stubbornly dovish. There was a firm signal that change was not imminent. As recently as last Friday, we had that article out suggesting that there was no change this week. So when the headlines hit yesterday, this obviously caught the market by surprise. And I think the price action that you're seeing both overnight and today is, again, emblematic of that. The yen strengthened, close to 2% yesterday. Again, almost 4% on the month. And again, a lot of that was this YCC premium in the market, the way that the market had priced the currency leading into the event.
Why not test it even more, though? We say, okay, UATA wants us to think it's weak. Why not treat it, though, like it is a change? Why not send JGBs to 1%? Why not continue on with the strength of the yen?
Look, I think they've been pretty clear that they don't want to see this type of volatility in the market, and they don't want to announce that kind of dramatic move. When you think about the way that the currency has traded so far this year, anytime we kind of, traded up towards that 145 level in dollar yen in particular, there was verbal intervention. There was a lot of pushback, again, on the volatility of the currency. So again, I think the way that they rolled out this announcement was with that goal that they can make this slight adjustment now, and that kind of eases the path for future policy change.
Okay, so when we're talking about the path for a future policy change, how far away realistically are we from that moment, Kristen, toward normal or the start of normalization?
So at this point, our call is looking for a complete scrap of YCC at the October meeting. Again, that is still a fairly far point away from actually taking rates into positive territory. So our base case right now is that they abandon YCC at the October meeting, they take rates to 0 in April of next year, and then they start hiking at that point.
Kristen, I'm getting some very serious whiplash, not just from the yen, but really the euro. I was very ready and perhaps prematurely was ready to declare the death of the strength of the euro, but it's stronger today. It's even stronger against the yen by more than 1%. What do you make of that type of volatile price action we've seen on a week of the ECB?
This has been a really interesting week for currencies. And again, I think yesterday when you saw the euro under pressure, it was really this perfect storm. You were coming out of a more hawkish Fed on Wednesday. You came into a clearly more dovish ECB message on Thursday. Again, while they're leaving the door open for future hikes, our call is actually that this was indeed the last hike of the cycle. And then you had this announcement and the leak yesterday, and then again the confirmation of the YCC tweak from the BOJ. So I think again, when you think about the euro and you think about the future path of the euro, we see fair value somewhere around that 113 level. The reality is, again, the economy has been weaker. The risks of recession clearly are increasing. And we've said for a long time that really for the euro to kind of move beyond that, you'd either need to see a sustained pickup in global growth that would put the dollar on the back foot, or you would need to see a large reallocation out of U.S. assets into European assets.
Okay, I'm looking at euro dollar that's at 110 right now, so you think there is a little bit more room to strengthen there. I just wonder on the dollar part of that equation, given as you're talking about the deterioration in European data with the GDP print we saw yesterday, with what we're seeing in personal spending as inflation cools, what does that mean for the dollar if all the signs seem to be pointing, at least right now, to a soft landing in the U.S.?
Look, the U.S. economy continues to go from strength to strength. And I think, again, when you look at the activity data over the last handful of weeks and months, it continues to surprise to the upside. Obviously Powell, leaned hawkish this week. I think he was very deliberate to not say anything that would allow the market to interpret as dovish. And it's very clear that he's still, leaving the door open for another hike. Our base case is that we see another hike later this year, most likely November. That will be peak rates. And again, we are pushing back against the idea that the Fed could start cutting as early as first quarter of next year. And I think Powell was very deliberate in his words around this when he said the committee will review potential cuts a full year from now. So when I think about what that means for the dollar, again, when I was on this show a week and a half ago, the dollar was under pressure. It was right after that softer CPI print. And I made the argument that the market was too quick to extrapolate out this trend, that this softer CPI print was going to be sustained. And I think Powell acknowledged exactly that at the meeting this week. So again, while the dollar is probably close to its peak as we're nearing peak Fed, this narrative around a broader dollar demise is likely premature as well.
Wait, so then how do we get to 113 on the euro? I realize that's a small move from where we're at 110, but if Europe is starting to look weaker, maybe the Fed has a little bit more juice, what's the trajectory look like?
Okay, there's obviously a lot of focus on China right now. And again, a big reason of why Europe hasn't hit some of its growth projections that we were talking about earlier in the year is because that China reopening story was weaker and disappointing to the market. I think a lot of that is priced in at this point. And if you do get surprise in stimulus or surprise in policy support out of China, that could certainly reignite some of the global growth outlook, and that would certainly be beneficial for Europe and the euro.
All right, China, the saving grace of the euro. Kristen, thank you so much for joining. Really appreciate your time. Kristen McLeod, Barclays co-head of Global FX Distribution and head of America's Macro Distribution. Still ahead, Intel surges after PC recovery delivers a surprise profit. We're going to have details in the startup next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further
And this business, I would still say, is like a coiled spring coming out of COVID, particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's Friday, the 28th of July. European stocks are weaker as the euro strengthens to end your week. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
It was the ugliest day since March, since SVB collapsed for both the euro and sterling yesterday. We're getting a reversal of that today. Not a complete reversal, but we're fighting our way back. The euro has fought its way back over above 110. Is this based on the data? Hard to say that considering yields aren't doing the same thing in Europe. Instead, yields are mostly reacting to the American story. We are having strength again by more than 0.5% for both of these currencies. Maybe it's just some adjustments here at the end of the week after a lot of volatility in positioning. We had a lot of European data from Germany escaping a flat quarter. Maybe that reflects that, but also softer inflation for most regions, save for Spain. Now, when it comes to the European stocks, a lot of earnings to digest when it comes to the reason we're falling, down about 0.2%. And Kaylee, I always want to assert that Europe is its own story, but let's be honest, a lot of this is just because of the U.S. When the U.S. market turned yesterday, Europe was already closed. Yeah. Europe ended higher by more than 1%, so it's probably just catching down to the U.S. session, to be honest.
Well, then maybe Europe's going to have some catching up to do come Monday, Danny, because U.S. stocks are kind of ripping to end the week on this Friday. It's being led by technology. The NASDAQ 100 is up about 1.6%. Now, part of that does have to do with earnings stories like Intel declaring the PC slump over, giving a better than expected forecast. That stock is up 5.2%. So that is one participant in that tech rally, but it really is quite broad. You only have a handful of stocks in the NASDAQ 100 that are down on the day. Maybe part of that has to do with the economic data here in the U.S. Of course, you had that incredibly resilient GDP data yesterday. You have strong spending coming through in the data this morning, but still a cooling in inflation. Where that leaves us at the moment on the 10-year Treasury yield is down 4 basis points to 3.95. But remember, we had a massive move upward in yields yesterday after that Nikkei report that the Bank OJ was thinking about tweaking yield curve control. And indeed, we did see that overnight. Hence why I have to point out dollar yen here. The dollar actually stronger against the yen by about 0.6%. But Danny, as I know you're about to point out, it's been a bit of a roller coaster.
It has. Kaylee, I also just want to point out, I know you didn't mean to say this, but you said the Bank of J, which could be the Bank of Japan or the Bank of J Powell. I'm going to start a petition to start calling the Fed the Bank of J. I absolutely love that. But you're right. I have a chart in front of me that's the 2 days of the yen, because as you showed on your board, it doesn't look like a lot of movement, but I just want to underscore the volatility we've seen in this thing the past 24 hours, the past 48 hours to be fair. Now, right here yesterday is when we got that Nikkei report, and you see the yen strengthen by more than 1%. Dollar plunges versus it. Euro also plunges more than 2%. Again, the biggest moves since March. We really hung around there, and then even when we got the BOJ decision coming down, there was some confusion because they didn't actually change their policy. They didn't change the ban. They didn't change the target. They just changed how they would enforce it. At first, you get yen selling off, and then we reverse a sharp drop in the dollar versus the yen, and we've kind of just I don't know, floated around this level. And Kaylee, we can debate and we will debate how big of a deal what Japan did was, but at the moment, the market is saying we're not going to make too much of a big deal out of it. Maybe we care more, for example, about the PCE and personal income data that we had.
Okay, let's just decide not to make that big of a deal out of the fact that I couldn't decide if I wanted to say Bank of Japan or BOJ, so I just kind of mashed them together. Danny, of course, we talked about the Bank of Japan and the BOJ earlier with Torsten Slok of Apollo. We were asking him how big he really thought this change was. Here was his answer.
This will likely be viewed as a major day in U.S. and Japanese fixed income markets because it does signal the end of the 7 years where yield curve control has been in place. And yes, we may get more widening further out, but the consequences are clear that Japanese investors will now be looking, and they already have expensive hedging costs for when they buy U.S. fixed income. But when they roll these hedges, then they will probably be looking at U.S. fixed income with different eyes now that yields in JGB markets will be going higher.
Well, Torsten Slok answered this in a clear way. It's our question of the day with the BOJ. Was it a tweak or a tide change? He thought it was a tide change. Let's now bring in our experts from Bloomberg. It's Eddie Vandervalt and Noor Al-Ali from the MLive team. Noor, let me start with you. Tweak or tide change?
Massive tide. This is the tide turning, Danny. I love it. Today is exactly the kind of day we come here and work in markets. You've seen that move, that momentous move, that shift in Japanese bonds today, definitely going to mark that steepening that we're seeing globally across bonds. And I think this is just the start of something incredibly exciting onto the next half of the year.
Okay, Eddie, is that the same for you? Are we in a brave new world?
Yeah, look, I think the Bank of Japan pulled off something momentous here. What they did was they convinced the market they haven't done very much, when in fact they are starting to exit yield curve control and looking for a world where they are not having to, absolutely dictate where yields are going to be. So I think it's quite a big step that they're taking. I think they are talking it down. I think the Bank of Japan is trying to say, hang on a second, we're not doing all that much really. And I think the market is buying hook, line, and sinker into that. And we're seeing some steepening of yield curves globally. But what they didn't do was cause a tsunami across the global bond markets. And I think, I think Ueda will go to bed tonight, or is in bed probably already tonight, thinking, wow, thank goodness the market reacted the way that it did. Because there was a real worry that once they exit yield curve control, that could disrupt global bond markets.
No, let's be honest. Ueda's at an izakaya somewhere, absolutely celebrating the triumph of what he's done, Eddie. Okay, on the market not moving, because I think this is a really interesting point. Is there some degree which, if you are a market participant, you don't want to sell above 50 basis points because the Bank of Japan, the Japanese government, owns half this market, and we just have no idea where they're going to buy at, that you could get just run over if you go too high?
Right, and I think that's why we haven't seen yields pop, because normally, when you remove a cap, you do expect to see some sort of a pop up to the higher level, provided that is where yields, that the upper limit of that range that you're suggesting is still below where the markets should be. Now, the fact that the Bank of Japan is a little bit vague in its communication, I think that helps. That helps them in not seeing that pop up to the higher levels. Now, I do think that we do see that drift higher, and that feeds through into global bond yields across the board, that we're going to see a steepening coming out of Japan. But at the moment, I think, yes, they'll be absolutely happy that they haven't pulled the trigger and been absolutely inundated with a run on Japanese bonds.
I guess, Noor, the question is, are they so much trying to control the bond market in terms of how high yields go, or was this actually a play at controlling how weak the yen is able to get, of stopping some of that weakness, trying to put some support under their currency?
Well, Kelly, that's an excellent question, because towards the end of his address, Ueda did talk about them considering, the FX market with today's decision. Obviously, that's still not dictated by today's decision. But I want to take a step back here. I know I always say this here when I come on the show, but it's an incredibly important moment because it really highlights these global themes that we're seeing, right? We're talking now about the Fed and the ECB ending or nearing the end of their tightening cycles here. Now, obviously, it's come at a point where the yield curve control. I'm getting a tongue twister just saying it here. But obviously here, this comes at a time where it could even point to the fact that we are comfortable now in loosening those or being more flexible in that control at a time when we're now thinking the global market is a lot more mature in the way it looks at bonds. And I think that's really important because it plays to the theme of that soft landing that we're seeing in the U.S., particularly when we talk about the PCA data that came out earlier today. And it also looks at potentially, Europe. Are we talking now about a pause? I think it really does change that global picture a lot more and makes it much more interesting.
It does. And what does it mean then to not just have a lot of changes, but to also be doing this during a summertime when we know people go away from their desks. They go enjoy the holidays. Volume tends to be lighter.
Yeah, absolutely. And when volume is lighter, you see higher volatility. And we saw realized volatility in the Japanese yen rise, particularly with the euro, Japanese yen cross and in the dollar cross. I mean, at some point today, it went up 1%, it went down 1%, and then it was unchanged on the day. And it shows you that even though those volumes potentially could be thinner, it shows you that these moves potentially do come back to earth, right? And that's really important. You have seen, though, the trend extending. And this is where we start looking at trends in the market rather than daily moves or daily sizes. And you've seen that steepening in the curves, especially on the treasuries led by the short end. You're seeing that play out. We've had about 4 days of consecutive steepening. I think that really ties to the global theme of, central banks now easing that pressure of those really intensive interest rates and starting to let that monetary lag or that transmission tool really play out as they now look to the economy potentially. And hopefully we're seeing some markers globally where the economy is a lot more resilient. However, though Europe now remains in question, particularly with the China angle and the PMIs and the CPI data that's coming next week.
All right, Nora, talking about central bank themes while also keeping the Barbie theme of the last several weeks alive. Love the outfit. By the way, guys, Warner Brothers just said Barbie has now raised $528.6 million worldwide. So if you haven't seen the movie, you're missing out.
Eddie's not having
Nora
it.
Ali and Eddie Vanderwalt of Bloomberg Markets Live. Eddie's an Oppenheimer guy. Thank you both so much for joining us. But coming up, we will get back to the serious business of the Bank of Japan and have more on our question of the day. Is it a tweak or a tide change? Sebastian Radler, Bank of America head of European equity strategy, will join us next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The names News that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Well, Germany exits recession, but questions are still remaining about the fundamental health of Europe's largest economy. Joining us now is someone who is in the country, Bloomberg Germany correspondent Oliver Crook. So, Oliver, let's talk about the data because, yes, we got GDP, but inflation as well. What kind of picture does it paint?
Yeah, Kaylee, I mean, the data out of Germany has been just basically terrible. I mean, you look at the PMI data for manufacturing. This is a, manufacturing-heavy economy at 38.8. The lowest it ever got during the pandemic when basically everything was ground to a halt was 35. So you're very close to that. Today, you've got the inflation out 6.5%. That's a lot higher than it is in a number of other nations within Europe. But also, you have the GDP that came in at 0%, flatlining, right? You had France come in at 1%, Spain at 2%. You have CPI and inflation and GDP in Spain basically at the same level, looking pretty good. Germany not looking good. Consumer kind of helped out this quarter in terms of GDP, but let me ask you a question. If you're in recession and then you stagnate, are you really out of recession? I guess that's a question for finer economic minds than my own.
I thought you were about to say mine because that is also true. That is not a question for me. Ollie, look, if one thing we can say is certain, it's if you are an important German corporate, you've done your earnings interview with Oliver Crook. You've talked to a lot of German companies. How is the macro picture impacting them?
That's right. Listen, overall, despite all this terrible data, you've actually had some pretty solid numbers from some pretty key players. We'll talk about Deutsche Bank first. They had pretty solid, earnings out. They said, I talked to James von Moltke, the CFO, about kind of what's going on in the economy. He says definitely the ECB effect is feeding through, but it's not broad-based. And he was extremely pessimistic. The House was pessimistic about Germany. He says he's starting to buy into the soft landing narrative here in Germany. Volkswagen, similar. There was optimism. Mercedes, they raised their guidance, so everything was looking there. However, if you look at SMEs, the Mittelstand, this is a huge proportion of the German economy, and there's questions there about what's really going on under the surface. They had a survey out 2 weeks ago saying that basically a fourth of these businesses were thinking about packing it up because conditions had gotten just too tough. So while on the top line, a lot of these more globally exposed companies seem to be doing okay, maybe having a soft landing, under the surface, it's a lot less clear. And as you can see, this is a huge number of sales in Germany, jobs, and number of firms in the country.
Oliver, thank you very much. That is Bloomberg's Oliver Crook in Germany. Now, let's talk more about the European equity call. And our next guest that joins us has a call of a 20% decline when it comes to EU equities. Let's bring him in. It's Sebastian Radler, Bank of America Head of European Equity Strategy. Sebastian, talk me through your call. 20% decline. How do we get there?
Well, growth has just accelerated very sharply at the start of the year. Everything went right. You had the end of the euro area energy crisis. You had China reopening. You had a lot of fiscal stimulus in the US with the budget deficit widening. That basically means global PMIs went up. Risk premia globally got compressed, and we had a strong rally in equities. And now the question is, will growth momentum stay strong? And your colleague Oliver was just highlighting PMIs are rolling over already in the euro area. They start to roll over in the US as well. And the number one driver of the cycle is the credit cycle driven by monetary policy. We haven't seen the full impact of all this monetary tightening yet. When it comes through by Q4, growth momentum will be meaningfully weaker. When growth momentum weakens, risk premia go up, asset prices go down.
Okay, so don't touch cyclicals with a 10-foot pole, Sebastian?
I think that's a good summary.
Okay, fair enough. What do you buy instead?
You buy the sectors that benefit the most when risk premia start to decompress. The best gauge for global risk premia are credit spreads. They're currently extremely tight. It's a little bit this 2007 feeling. Remember, in April 2007, credit spreads were extremely tight despite all the worries that you saw on the horizon. And then once growth momentum started to weaken, risk premia went wider. And we think that's basically on the cards as well. Who benefits in that environment? The very safe kind of defensive sectors. That's food and beverages and pharma and quality stocks relative to the rest of the market.
Sebastian, I'm looking at some of the stats of this earnings season that you and the team compiled. 46% of companies companies beat. It's the weakest since 2019. EPS surprises are negative for the first time in 10 years. Are we going to look back at last quarter and say that was the peak and that was the peak for some time?
I think so. The question is, how long does the downturn last? We think it should trough out at some point early next year. But you had a temporary reacceleration. Earnings are still 12 and 40 EPS are still basically at peak levels. The next step clearly is lower. So what I'm seeing, and that comes a little bit to your earlier question, you've got an environment where there's a lot of scope for earnings to decline and for risk premium to move up. That's clearly not a great environment to be long the market.
And yet we have seen the rally that we have seen to this point, Sebastian. I just wonder if in the longer term you don't necessarily think it's sustainable. You want to position more defensively. Does it have a last run here in the near term as the soft landing narrative is building in the U.S.? The ECB is coming off as more dovish. Earnings right now are not that bad. So how much farther does it have to go before it might inevitably collapse?
Yeah, so there are effectively two drivers of that. And you have a very complicated macro picture, so it really helps to boil it down to the essentials. One is the credit cycle, which is tightening dramatically both in Europe and in the US. If you look at credit conditions in the US, it would suggest GDP growth, which yesterday came out at 2.4%, should already be 4 percentage points below trend. The first question is, will this tightening of credit conditions continue? And you say, oh, the central bank stopped tightening now, so everything is fine. But remember, there's typically a lag of 9 to 10 months. So the tightening you've done in the past will now feed through a week in the economy. And secondly, you had simply a lot of fiscal easing in the US. You've widened the budget deficit, but that looks unsustainable. The deficit is already extremely wide. Remember, the US government is spending more now on servicing the interest costs than on defense. It's very hard for them to keep widening the deficit. So if the fiscal impulse basically stops supporting the economy, the credit drag fully comes in, then the slowdown should start. And I should say, global PMIs have now declined for 2 months. I would argue the slowdown has already started.
Can we talk about a narrative that the bulls use to justify their case? It's China. We talked to a guest earlier. It was on FX, so I realize not your world, on the euro, that China would come to save the day for the euro. Do you buy that narrative? Can we rely on China?
Yeah, so I think there are two questions. A, would they have the firepower if they acted? And the answer is absolutely. We've seen it many times. 2008, they did enormous fiscal stimulus, effectively saved the global economy. Again, 2015. So if the credit cycle and the fiscal cycle in China really kick in, it can make a difference. It's not as important as the US, but it matters. The problem is that our economists highlight the run rate in GDP growth in China in the first half of the year was 5.1%, above their target. They have very bad memories of the stimulus they've done before. They simply need to see more pain to stimulate. So our economists say only fine-tuning for now, and that's not going to be enough.
Sticking in the Asian region, and I realize this is largely a bond market question, but we've been talking all morning about the Bank of Japan, tweaks to yield curve control, the idea that JGBs may actually start to yield more and pull money away from either treasuries, other bond markets, but could it have an effect ultimately on equities as well if you can go get some higher yield in Japan?
Absolutely. So the way I would think about equities, there are two main drivers. The one is growth momentum, which drives risk premium. That's what we've been discussing just now. And when that really starts moving, it tends to be the dominant element. But the second factor is the discount rate. So if real bond yields were to go up, all other things being equal, that would be negative for equities. And so one interesting question at the start of the year for the people who are bearish is, why are you bearish? Are you worried about weaker growth, or are you worried about a higher discount rate? So if you think this is going to be the dominant element, basically the Bank of Japan starting to contribute to this tightening dynamics, pushing bond yields higher, that would be negative for equities. But I'm saying a far more likely scenario is growth is going to weaken, as it always does when you have this tremendous monetary tightening feeding through into a weaker economy with a lag. And so I think that will, over the next 3 to 6 months, be a far more important story than these kind of fine-tuning of efforts by the Bank of Japan.
I mean, Sebastian, I got to be honest, basically every Friday I look at the flow show from Bank of America. I can't end my week without it. But there has been relentless outflows out of European equity funds. Is there not some degree where that is just a contrarian indicator, and that in its own positioning will mean we can go higher in less than a minute here, Sebastian?
Yeah. So the simple question is, what is it that really drives equities? And effectively, your question answers itself. You had all these outflows, but European equities have now gone to a multi-month high.
True.
It hasn't made a difference.
Yeah.
What has happened is growth has accelerated, pushing up equities. So what I'm saying is that really makes a mark. If growth weakens, very likely we go the other way.
All right, Sebastian Radler of Bank of America, thank you so much for joining us on this Friday. Have a great weekend. This is Bloomberg.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Let's start that we had a fantastic quarter. It was the best quarter we ever had in our history in the second quarter. And we see still very strong demand. If you look at the bookings for the third and for the fourth quarter, it's actually even stronger than what we have seen, let's say, in the first quarter. So we don't see any drop in demand, and we still have, let's say, high yields.
Steven Zott, Air France KLM CFO, speaking to Bloomberg's Lizzie Burden earlier. Even though they outperformed on their earnings, shares actually heading lower today off the back of some disappointment when it comes to things like costs and the supply chain for them. All right, we are 4 minutes, give or take a few, before the European markets close. I want to give you some of your last calls. L'Oreal reporting earnings today. Most of the analyst notes are positive. Jeffrey saying that it was a strong set of results, that even though there was a little bit of weakness in China and the U.S., Europe made up for that. So those shares are moving higher by about 2 1/3%. Keeping the theme going here with luxury earnings. I don't know if you can call L'Oreal Lux, but you know, we'll make it work. Hermes, they also had really strong earnings. I basically read through every analyst report for Hermes, and analysts just love this stock, saying, look, they are the upper echelon of luxury. Nobody can touch them. Citi was among that, saying that they had the best-in-class revenue and earnings growth. In terms of 52-week highs, we see some Italian banks making new highs, Intesa Sanpaolo being one of them, and we're seeing, because of their earnings that were strong, Mediobanca follow along. Basically just higher interest rates from the ECB helping them. We heard something similar from other Italian banks. HSBC off the back of strong Stan Charter earnings, that also gains 0.5%. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating
World Cup. This is a three. As the economic picture does. The BOK is getting ready to make a decision.
Stocks just finishing up the trading day here in Europe. As a whole, the European index is down just barely, less than 0.2%. It's going to differ depending on what region you're looking at. DAX and CAC are on both of those outperforming today, ending the day up about 0.4%. FTSE MIB, that's lower despite the fact we do have some good earnings coming from Italian banks. UK stocks, those are flat. The Iberian Peninsula also flat too. We might have a down day, but for the entirety of the week, we are ending higher. The saving grace was yesterday. European stocks absolutely ripped yesterday, ended the day higher by more than 1%. So that was able to wipe out some of the losses we've seen today. You can see that jump right here. I mean, this is pretty remarkable. It probably helped European stocks that they were closed when the BOJ madness started to happen, when the Nikkei had that report. Even so, they didn't lose too much steam today. Maybe it was our interpretation of the ECB, maybe it was earnings, but really at the back half of the week is when we had some excitement. Now, in terms of today's individual movers, again, all earnings based I have for you here. Standard Chartered, strong, announced buybacks. They ended the day up some 4%. It's the story of higher yields helping them out. It's the story for all banks. The question turns, have NIMs peaked? Do they need to give back more to borrowers? In this scenario, are they going to go look for higher yields elsewhere? Airlines also doing well. Really, the last two stocks I have are a story of consumer strength. Record profit for IAG. This is the parent company of British Airways. Those shares ending up higher by almost 6%. Hermes strong too. The luxury goods sector was really interesting this week because we saw a lot of differences. Hermes, strong growth in U.S. and China. You looked at LVMH earlier this week. They really lagged in the U.S. But Hermes, of course, has that pricing power. If you need to go on a wait list for a Birkin bag, then perhaps you'll be able to keep those sales going. In terms of the week ahead, it's another week of a lot of earnings. Let's get through some of them, but we start the week with European data. We'll have CPI. We had some inflation data out of Germany and Spain, which seemed to suggest different stories. How will it all play out for the overall CPI? HSBC earnings, those hit on Tuesday. The shares moved higher off the back of positive Standard Chartered earnings. Also going to have some home builder earnings on Wednesday with Taylor Wimpey. Then Thursday, the big macro decision. They were left out of the central bank palooza this week, but the BOE goes on Thursday. At the moment, market pricing in 25 basis points of hikes. And then finally, more bank earnings, Kaylee, to end the week. Commerce Bank, Credit Agricole. Again, the story for most of them has been higher rates helping them out.
All right, Danny, well, let's get back to the data story since we're going to get a lot more of it in Europe next week. William de Wilder, chief economist at BNP Paribas, is joining us now. So, William, obviously we are coming off of an ECB decision yesterday, which could be perceived as dovish. It's unclear what the move in September is going to be and what story, frankly, the data is telling them when it comes to some pretty disappointing growth-oriented data like PMIs when inflation still is not where the ECB would like it to be. So the data next week and, frankly, the data up until the September meeting, what do you think it's going to send in terms of signaling to the central bank?
Well, it is clear that we need more evidence that inflation is continuing to move in the right direction, that is downwards at a sufficiently fast pace. I think in that respect, when you look at the recent, the European Commission data, survey data that were released this morning, in Europe, we had good news in manufacturing, but if you look at pricing intentions and services, they have not moved further down. So that's an element of concern. Another point of concern is wage growth, of course, which is an important component of service price inflation. Now, the relief, in a way, if you look at the positive development, is the ECB also published the results of its phone survey with companies, a bit the equivalent of the Fed's beige book. And there, the survey did show that companies expect wage growth to gradually slow down. So you have, on the one hand, on the other hand, typical situation.
Hey, William, can you help interpret this for me? Some of the central bank speak we got post-decision from the ECB. Villeroy has kind of hinted that there's more potential for a September pause. Meanwhile, the more hawkish members, Casimir and Shimkus, saying we're closer to the peak, and if we pause in September, it does not mean there will be no more hikes. How are you interpreting the ECB tea leaves?
Well, clearly there was a very important shift in message yesterday, and that really hints at a pause in September. That means that for us, in our view, the bar that needs to be reached in terms of data, meaning bad data, to hike in September is now pretty high. And we should not expect from any central bank at the current juncture that it would give any clear guidance beyond what the ECB has said. I think it was already fantastic, the message that was given. And we actually think that we are already at the peak. September is a pause, and that beyond that, we will see more evidence of inflation going in the right direction, and also more evidence that growth is indeed going to stagnate in the second half of this year.
Okay, so that's the story in Europe. William, if I also could just ask you, given the news over the last 24 hours, about the Bank of Japan, this tweak, if you will, to the yield curve control program that we've had multiple guests tell us today that this is opening the door to perhaps a tidal wave of change in Japan. How should we be thinking about this?
I'm following this with some degree of concern, I must say. The announcement today, all those night was, I would say, there was an element of surprise in there. I also think about what the BOJ Governor Ueda said at Sintra, in which he was said, well, we will look in the latter part of the year at our inflation forecast for 24, and in particular at the wage forecast, and that's going to dictate the policy. Now, what is the element of concern? It is not the normalization, the start of normalization per se. It is what can it have in terms of global knock-on effects? What is the extent of carry trade that would be financed out of yen? These things. Let's also not forget that the ECB, in its recent financial stability report, also mentioned that explicitly. So that, I think, is going to be a point of attention for investors in the fall of this year.
William, thank you so much for joining us. William de Wilder there, Chief Economist at BNP Paribas. I want to give you a quick check on where European stocks have settled as we go to the break. The DAX, I just want to linger on this for a moment because it is the outperformer. Well, there's Trump. He's not the reason it's outperforming. But the DAX really outperformed today, up 0.4%. Kaylee, I think this is interesting because the biggest mover of the DAX is BASF. BASF is a chemicals company. They reported earnings and hinted towards a gradual recovery in chemicals. That is important because that sector has been beat down, and chemicals are used in literally everything. If chemicals are doing poorly, then Europe is doing poorly. The fact they saw a recovery is good news for Europe. I also want to show you what currencies are doing right now, specifically the best FX pair of the week. It is euro-yen. This thing was plunging yesterday, down more than 2%, the biggest decline since March off the back of a Nikkei report of tweaks to YCC. We got the tweaks, and look what's happening. It is climbing. It is up more than 1%. The euro is stronger by more than 1% versus the Japanese yen. We're almost undoing all of that action that we saw yesterday. It just shows you the remarkable nature of what Kazuo Ueda was able to do and the calmness that has been restored to the market since his overnight decision. All right, coming up, we are going to get to Trump. Former President Donald Trump and Ron DeSantis will be at a dinner for Republicans in Iowa today. We're going to look at what the latest charges against the former president mean for the 2024 race. This is Bloomberg.
politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Former President Donald Trump was hit with new obstruction charges in the criminal case over his handling of classified documents. Let's get more on the political implications of this, aside from the legal ones, and bring in Terry Haynes, Pangea Policy founder. So, Terry, of course, this is the federal indictment he is already under related to the taking of classified documents from his time at the White House to Mar-a-Lago. Those are the allegations here. Now there is an allegation that he asked an employee to delete video footage regarding this case. We saw, though, when this initial indictment happened, as well as when he was indicted in the state of New York related to hush money payments to Stormy Daniels, that it helped him in the polls and enabled him to raise millions of dollars for his campaign. Especially now, as we're all watching the wires to see if he is indicted again on a new indictment related to the investigation into January 6th. When does it stop being a good thing?
Well, you know, I think we've probably seen peak Trump, Kaylee. You know, there's a lot of outrage, and there's certainly part of the party that cares deeply about the president and wants him to succeed. At the same time, you know, what you've got here is a situation where if you look at the polls, both nationally and in early primary states, which are much more important than the national beauty contest, you've got at most half of the folks being for Trump, which means that half aren't already. And as we continue on through the summer and the fall, I think one thing that's going to happen here is that the president starts to sink under the weight of 1,000 paper cuts as more and more people find him, including primary voters, find him to be unelectable, and as the Republican nominee challengers start to sharpen up their criticisms of Trump. And for Republicans, whether they be nominees or or voters, there's no contradiction in saying that they think Trump is being treated unfairly, but yet that he probably can't win in 2024, and we'd like somebody to put forward Trump policies and win as well.
So it's not necessarily one tipping point. It's a slow-moving situation, a slow-moving decline. Do then his competitors for just the Republican nomination, then, will there be some hesitancy to speak out then before it is too soon? Before the rest of the voting population have also turned? Are they going to face that type of danger then? Again, if this is going to be slow moving.
Well, I think that's a very good question, Danny. I think the answer is that what you're going to find is you're going to find the challengers kind of leading the pack to some extent. You already see this with Governor Christie, but I think increasingly you're going to see it with others. And they've got a deadline in which to start doing that, which is August 23rd, the time of the first Republican debate. Whether Trump is there or not, you're going to have a half a dozen or more challengers who are there, and they're all going to need to talk about how they feel about this. And and I think with Christie in the lead, they're going to ramp up criticisms of Trump personally of the legal peril and all the rest, and say, look, we've got a bunch of good policies, and that's what people can run on. And what you're going to get is me, the challenger, the policies without the baggage, and that I think will continue to be even more appealing, although I think there's a rump that will not drop Trump.
Okay, so we talk about what it's going to do to his Republican challengers, but unless something changes materially, even if his outright frontrunner status changes, he could still very well be the Republican nominee, Terry. And the man he's going to be up against, theoretically, unless something changes there, is Joe Biden, the current president. When we think about the challenges facing President Biden, it's not legal challenges of his own. It's legal challenges related to his son. We saw what happened with Hunter Biden's plea deal falling apart in court earlier this week. Still very much a question that I'm assuming is going to be overhanging this campaign in this White House, yet he hasn't been very vocal about it. How big of a problem is Hunter for Joe?
Hunter's a big problem and getting bigger. I would, just a few weeks ago, let me put it this way, just a few weeks ago, the announcement of additional Trump indictments was, front page news, stop the press. Now what we've got is a situation where, as my daughter put it to me yesterday, well, another Trump indictment's like a day that ends in Y, isn't it? And on top of that, though, the significant fact this week, I think, is the rejection of the Hunter Biden plea deal. Why that's important, frankly, is because that's not really so much about Hunter Biden. It's whether Hunter Biden was in business in some way with his father, and or whether his father was enriched illegally by the things that Hunter Biden was doing. There's a variety of significant things on that front. The plea deal itself implodes over a dispute about whether other potential felonies and misdemeanors that Hunter allegedly committed. At least the tax division thinks that that's the case. And whether or not those go away or not as a result of the plea deal, firstly. Secondly, the congressional investigations now look more credible as a result of that. And thirdly, the White House has now changed its story on Hunter. The president's been going on for 4 years about how he never discussed business with his son, and now it was never in business with his son. That change of language is probably not coincidental. And so, what you've got here is a situation where, both front-runner candidates are in increasing peril politically and legally.
Another issue that precedes the Hunter Biden issue for all of Washington is the age of the city, the age of the politicians. It was thrust back into the zeitgeist with McConnell's press conference. Terry, do you think anything changes on that front in terms of voters and how they behave? Does this become increasingly more of an issue?
Oh, absolutely. It's been a large issue to begin with. Over half of voters already don't think the president should run, and that only gets more entrenched the more gaffes that happen. The latest gaffe about curing cancer and earlier this week, and the like. And on top of the age issue too, you've got economic performance and whatever whatever Washington, New York bubble the administration wants to tout Bidenomics in and as. That's not selling with the rest of the country, and the vast majority of the country thinks that the administration is doing a poor job on economics. So that pain's real, that pain's out there, and I think that's going to continue for some time.
Well, the president is set to give an address on Bidenomics later on this afternoon, just about an hour and a half from now, actually. Terry, finally, on this Friday, it is July 28th. Washington is actually quite quiet. Congress is gone. The August recess is upon us. They got some things done in the last week, but come September, there's going to be a lot of work to do. Where do you put the odds of a government shutdown this fall?
I'm today saying that there's a 60% chance that there's a government shutdown. And that's probably a non-consensus high, but I was a non-consensus high over the past several months before we got a debt ceiling deal, and I told everybody that was going to come down to the wire, and nobody believed me, but then they started to. There are political, in a closely divided Washington, there are political reasons for both parties to want to make as much of a show as possible about their priorities, and that's largely what's going to happen. Now, for markets, shutdowns in the past haven't mattered a whole lot, but I think this time it's going to be a little bit different, because what ends up happening is there's going to be some concern about whether the top line numbers in the budget deal that was reached in the spring actually get ratified in the fall. There'll be concern about defense funding, semiconductor funding. Things will splash across the spectrum and lead to some market jitters about this. But in the end, I think things are going to be okay.
Terry, I'm afraid we're going to have to end it there. Thank you so much for joining Kaylee and me. That's Terry Haynes, Pangea Policy Founder. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
We've seen the product related to the movie selling out very fast. We also expect to see impact on the Barbie brand overall. And since the movie launch, or I would say from the beginning of the third quarter, we're seeing significant improvement in POS in Barbie. And we expect that to continue to translate to strong performance overall for the brand.
come on, you know you couldn't have Mattel on and not ask them about Barbie. Kaylee, we're just discussing some of the superlatives of this movie. The strongest opening of the year. It has raised more than $528.6 million total worldwide. But the issue I take with all these superlatives, Kaylee, is it's not adjusted for inflation. Something else might have been more. But again, it's not adjusted for inflation. I think that's the real issue here.
Yeah, I think it's a very good point because I went and saw Barbie. My tickets were not cheap, but neither was my popcorn or my water bottle. That obviously doesn't factor into Warner Brothers figures here. That said, for everyone holding out on seeing Barbie, I really enjoyed the movie. And my husband, the first thing he said when he walked out of the theater was, I would see that again. So I wonder how many repeat people are going to come back too. And if this is going to be a billion-dollar film we're talking about by the end of the summer. Abigail Doolittle, I know you're watching the markets, but have you watched Barbie yet?
I have certainly not seen Barbie, but I wear a lot of pink, so people have been calling me Barbie. As for the markets, it's all green. We have a big risk-on rally here on this Friday. The S&P 500 up 1.2%, the NASDAQ 100 up 2%, and then take a look at the NASDAQ Golden Dragon Index up 6%. The last time I looked about 5 minutes ago, that's the best day since January, but it's up even more, so perhaps it's up at this point even more. So on the day, we do have yields down. That's certainly helping out. The 2-year yield down about 5 basis points. If we take a look at some of the big movers on the day, we're going to see that Meta is back toward what would have been yesterday's highs, considering we had that reversal. So investors still really liking that quarter and that outlook that they gave. Intel, a good quarter, a great outlook, the return of the personal PC, and then Advanced Micro kind of going along with the wind of Intel and sympathy. But plus, we also have them investing $400 million in India. Now, everybody's talking about where are their catch-up trades, so Alphabet could be one. Well, take a look at Intel. This is since the pandemic, down 20%. The chips overall, Danny, up 80%. If ever there was a catch-up trade, it could be Intel.
Yeah, they just have to go all in on that AI story. Abigail, thank you so much. Bloomberg's Abigail Doolittle. Now, coming up, more tech to be discussed. Pat Genslinger, Intel CEO, is going to be joining the Bloomberg technology team. That will be with Caroline Hyde and Ed Ludlow. You know AI is going to be a topic. How do they catch up to the AMD and the NVIDIAs of the world? That's it for Kaylee and me on this Friday. This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said they're long and very
variable lags and the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow here in San Francisco. Caroline Hyde is off today. This is Bloomberg Technology. Let's get after it. Coming up, Intel surging as its long-awaited comeback is underway. We're going to break down the company's earnings with the CEO, Pat Gelsinger. Plus, we're going to have an exclusive interview with the CEO of Buy Now, Pay Later company, Affirm, his outlook on fintech and the payment space. And we'll push ahead to what is going to be another crazy week in tech earnings with Amazon, Apple, and Qualcomm all reporting next week. First, let's get a check on markets. Earnings has been a key theme this week for the technology sector. Let's get over to Bloomberg's Abigail Doolittle with the numbers. Abby.
Well, Ed, it's certainly been a big week for earnings this week, and it will, to your point, be one next week. So far, investors liking it. The fear around this earnings quarter and ripples, the idea that perhaps the bar was going to be too high. Well, it's simply not happening yet, at least with some of the tech movers. But overall, you can see on the day we have a very nice rally at this point. The major indexes all up more than 1%. The tech-heavy NASDAQ, tech-heavy index is up more than 2%. And we have the New York FANG index up even more, up about 2.3%. So really pretty impressive performance there. Now, if we take a look on the week, the standout sector for the S&P 500, not surprisingly, the communication services sector, that's the one that has your Meta and your Alphabet. And what did they do, Ed? Well, of course, they put up great quarters and outlooks driven by this recovery in ad sales or firmer ad sales. So if we take a look at Alphabet on the week, we're going to see pretty solid gains. The same deal for, well, actually at this point we have Microsoft down on the week. That was one of the exceptions to the quarters that we had this week, Ed, and that had to do with the fact that revenue growth stayed in the high single-digit area and the cloud missed a little bit. So that sets up Apple for next week, because Apple's revenue for the quarter that just was, it's expected to decline 2.5%. Is that a low bar, or is that going to present some kind of issue going ahead? We don't know. But what all of these stocks are facing is that NASDAQ 100 on the year up more than 40%, price to perfection, too far, too fast. The sugar rush that we saw yesterday, it faded a little bit. Well, of course, it's back today. At some point, this probably will give way, but we're seeing no signs of that certainly today. So it's all eyes on next week and those big earnings reports.
All right, Bloomberg's Abigail Doolittle out in New York. Happy Friday to you. We're going to stick with tech out this way out west. Earnings next week include Apple, Amazon, and Qualcomm. It's been an interesting dynamic where the market is so hyped up about AI, but if you look at the trading, I think we're kind of focused on some of the core businesses of these names. Will that be the story next week? Let's ask Jonathan Curtis, Director of Portfolio Management for Franklin Equity, overseeing $9.5 billion in assets under management. What do you make of that, Jonathan? Investors love AI, but this week it seems like they traded on the fundamentals, the core business.
Yeah, well, so certainly there's a lot of excitement, and appropriately so, around AI. But we are in the stage of this opportunity that we like to call the experimentation phase. Companies are learning about how to use generative AI. They've been reorienting their product roadmaps to take advantage of AI. They're starting to figure out what their customers are going to be willing to pay for some of these capabilities. But we're not really in the scale it stage. We think that's going to come here in the next 2 to 3, maybe 4 quarters. And the biggest, most important thing to be watching there is what platforms like Microsoft or Adobe or other companies that have many hundreds of millions of users can do when they start putting these AI capabilities in their products, where hundreds of millions of knowledge workers and media creators operate every single day. We're quite excited about what that means and how that will put pressure on the underlying infrastructure and semiconductor layer and keep the growth going for a lot of these companies.
So we do this every quarter now, track the number of times AI as a phrase or word is mentioned on an earnings call. Do you go through the transcript and say, okay, AI number one, AI number two? I mean, seriously, how much does that impact your investment thesis?
We did do that, yeah. So this past earnings cycle, not this current one because we're not completely through it, we did go through and count how many references there were to artificial intelligence. And then we compared it to references to things like mobile back around the launch of the iPhone, because we wanted to get a sense for how quickly this was dispersing through the economy relative to other big cycles that we've seen in the past.
But Jonathan, why, Jonathan? They're just words. What do they tell you about?
No, they're not just words. They're intentionality. And what's important about that intentionality is it tells you how much the other sectors outside of the economy, outside of tech, are gearing up and getting curious about this opportunity and ultimately what the big spending is going to come. And what's fascinating about the analysis we did 90 days ago was that we saw much more dispersion for artificial intelligence than we did for mobile back at the start of the iPhone cycle, the iPhone opportunity. So that gives us a little bit of confidence that this could be even bigger than other big cycles we've seen in the past, like mobile.
Jonathan, I want to talk about the semiconductor names. We're going to be speaking to Pat Gelsinger in about 5 minutes' time, the CEO of Intel. You do not hold Intel, but I believe you do hold NVIDIA and AMD. Explain that thesis to me and why they are the winners in AI.
Yeah, so certainly Intel is an amazing company. There are funds within Franklin that own Intel. They are in the midst of a challenging transformation. And they're a little too PC-centric for our growth needs. And they're in a heavy investment stage right now. So we're watching Intel closely. We like NVIDIA because they're highly aligned with the AI opportunity and have an incredible moat there. We like AMD because they are a share gainer in the server space at the expense of Intel. We also like TSMC, which is one of Intel's emerging competitors in the fabrication of chips. And AMD and TSMC and NVIDIA and TSMC together are really helping set the next stage of growth in the semiconductor space. And Intel is just playing catch-up, quite frankly, and is a little too PC-centric for our interests.
PC-centric. The other area we want to talk about is cloud. And we started this conversation, Jonathan, by pointing out that a lot of the trading this week was done on core legacy businesses. Abigail mentioned Microsoft, where investors looked at the performance of the cloud business from a top-line growth perspective and weren't as happy. What do you see there?
Well, encouragingly, we are starting to see some of that deceleration that we've been seeing in cloud in this post-COVID era starting to calm down a bit. And in fact, the deceleration that Microsoft witnessed in its cloud business slowed a bit. And encouragingly, we're starting to see the real positive impacts from the AI experimentation phase that we're in right now impacting the cloud operators like Microsoft, like Google. So we think that we are getting through the optimization phase post-COVID. We are getting into easier comps there. And now we're starting to see AI become a material contributor to these cloud businesses. So we think in our broader digital transformation thesis, AI is still misunderstood by investors. They don't understand how profound the impacts of this is going to be. And then the cloud opportunity is going to be a big participant along with AI, but also as digital transformation continues. And we're starting to see that stabilization. So we're quite encouraged by both what we're seeing in AI and in cloud.
All right, Jonathan Curtis, Franklin Equity Group, Director of Portfolio Strategy. Just such a wide-ranging conversation. And as we discussed, the next big conversation is going to be about the chip sector. Thank you very much. Coming up, stay tuned, because we will sit down with the CEO of Intel, Pat Gelsinger. The market really liked what it had to hear about the quarter just gone and the outlook for the current quarter. But there are long-term questions here about Intel returning to a position of leadership when it comes to the cutting edge of chip manufacturing, chip-making technology, and also, what is the future of this company in the field of AI? Pat Gelsinger, Intel CEO, coming up next here in San Francisco. This is Bloomberg Technology.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I want to welcome our global Bloomberg TV and radio audiences. Intel shares are jumping, with investors buying into signs that the chipmaker's long-awaited comeback is underway. Intel is forecasting sales in the current quarter of $13.9 billion, ahead of expectations. The company also notched a surprise profit of 13 cents a share in the quarter just gone, as a slump in demand for personal computers appears to be coming to an end. It's not all good news. Server demand isn't recovering as quickly. The company's still a little bit far from its heyday, where margins were at 60%, sales were nearer to $20 billion. Even so, joining us now, Intel's CEO, Pat Gelsinger. You know, Pat, this is the second consecutive quarter where investors have cheered the earnings results. Shares are up. And I think before 2023, 10 out of the 11 earnings prints that you had, shares fell. Is this job done for you in the turnaround at Intel?
Well, Ed, we have a long way to go yet. But boy, having two good beat and raise quarters in a row, is super positive and really, I think, indicative of that turning point for the company. But we still have a lot of work to do yet. As we said, our client business is now, healthy footing. We've returned market share to where it traditionally was, a strong roadmap. The market's recovering, inventory levels are good. Data center, we still have work to do, but boy, 2 quarters in a row where we did a bit better than we expected, but we still have challenges in AI, and many of our really good products are only coming to market over the next year. Networking, still a lot of inventory to work through, and our foundry business is still just a seedling, just starting to show some green shoots. So I'll say, boy, far from finished, but it is nice bouncing off the bottom a bit and feeling that momentum in the market response.
Pat, why do you have the confidence to kind of call the end of the PC slump and also at the same time state that the server recovery is delayed to the end of the year?
Yeah, in the PC side, inventory levels are now healthy, right? Everything that we've seen and a lot of the, issues that we worked through Q4, Q1, and Q2 were over inventory levels by the OEMs and the channel. And now everything is healthy. Our roadmap is very good. We've gained share multiple times in a row. I think we're now at 5 out of 6 quarters where we've gained market share. So I just say in the PC business, healthy. Our position is good. And we're looking forward to the AI PC. And with our launch of our next generation product, Meteor Lake, later this year, we believe that ushers in the AI PC generation. And I've compared that to like Centrino and Wi-Fi, 2 decades ago, a major new use case for why the PC is the best platform. So we're quite excited about that. On the data center side, we still saw that, the inventory levels still persist. China was weaker than expected. Their recovery is going slower. And, cyclically, we see the shift toward AI. These big training machines, every cloud vendor is shifting their dollars to more focus on that. So those three things are leading to a bit longer recovery cycle on the data center. But like I said, we performed a bit better than we thought on the data center in Q1 and Q2. So we're feeling like our momentum and execution is rebuilding despite some of those headwinds that still persist in that area.
For our global TV and radio audience here at Bloomberg, we're speaking to Pat Gelsinger, the Intel CEO. Pat, you're forecasting gross margin of 43% in the current period. But it's a long way from that 60% gross margin level. Wall Street used to look at Intel and say 60%. They would cheer you as a leader in that space. Can you just explain to our global audience the timeline and path to getting back to profit at that level?
Yeah, and we're working our way back in margins, and obviously a nice beat in Q2 on margins, and we forecast Q3 a bit better and Q4 a bit better. And part of it is the cyclicality of the semiconductor industry is brutal on margins. And when we, had an oversupply situation, inventory, that just depresses margins because, the factories cost the same whether they're full or whether they're empty. So you end up with these charges that, burden the price points and depress margins. We also realize that our own product execution has weakened our product position, which doesn't have ASPs as strong as well. So that's another factor. And the last factor here is, the plan that my CFO, Dave, and I have laid out is an expensive plan. We are making aggressive investments to build the capacity to get back to leadership. And thus, we're moving through nodes very rapidly. We said 5 nodes in 4 years. So that causes us to have a lot of undepreciated, capacity that we're working through quite aggressively. Also building up a bit more capacity for our foundry initiatives. So all of those factors depressed margins, to historically low levels in the first part of the year. And we're just seeing ourselves now working to build back to margin levels. But we're still very confident that as we build our foundry business, get back to leadership and process and products, that those kind of margins, that's exactly what Dave and I aspire to the future. And we feel like Q2 was a good marker, that yes, we're building momentum to get back there.
Thank you for joining us here on Bloomberg Television and Radio Worldwide. We're joined by Pat Gelsinger, Intel's CEO. You described the foundry business as a seedling, but every time you and I have spoken, you've hinted that there is a big customer waiting in the wings to give life to that business. What can you tell us about that, Pat?
Yeah, and we're having good momentum. And as I said on the earnings call yesterday, we have 2 big customers in particular that we made very good progress over the last quarter for our foundry business. We did have one, I'll say, confirmatory, not as big a customer, but the Ericsson announcement, their commitment to 18A and our next generation work, with them that we announced this quarter. So I'll say overall, we're seeing good momentum and a really strong pipeline of customers, and we hope to make, meaningful announcements later this year on that. We also pointed out on our earnings call that now we're seeing a lot of interest in our packaging technology. So it isn't just wafer manufacturing, it's also package assembly and test. And Intel has long-term been a leader in packaging technologies. And because of key areas like high-performance computing and AI, there's tremendous interest in these advanced packaging technologies. And we're finding a lot of customer interest in that incremental area of the foundry business as well. So overall, and the numbers were good for us in Q2 for foundry, great pipeline of activities, great progress on a couple of these most major opportunities. So I'm feeling good, like we're starting to really see that momentum build in this new business area for Intel, our Intel Foundry Services.
If we think about what a potential customer might be, at the scale of Apple or Google or NVIDIA, what is it that they want from you? What is it do you think that you can provide them?
Yeah, when I view it, we have to go through 4 stages. One is, are my transistors good? Can they build good products using Intel? Second is, do I have the design tools, the Cadence and Synopsys EDAs and the IP libraries? Have we gotten all of those basics done so that they can design on us? Then third, do we have good terms and conditions? Are they better off coming to me versus, TSMC or Samsung as an alternative? And then finally, are we customer oriented? Can they really have the support? Because my factory becomes their factory. So we have to work through all four of those stages before they're ready to commit major businesses to us. And that's why it takes a while. They got to do designs and tests and pilots and, work through the financials. And, this isn't a mature business area for us. But I'll just say we're making great progress. And in particular, the two most significant opportunities, it was a really good quarter. And I'm feeling very optimistic that, yes, we'll bring them across the line and start to really accomplish what we've laid out, with our, reshoring and building the Western foundry. We also had great success with both the EU and the U.S. CHIPS Act this last quarter, which are affirming the strong support, of the Western governments on this strategy. It's the right strategy at the right time. We're making good progress.
A big part of your smart capital approach. We have to talk about AI. You see a world in which the PC plays a role for localized running of LLMs. But what are the use cases that you see, Pat? The applications where a PC with AI-specific chips is relevant?
Yeah, and, to some degree, they're numerous, Ed. Let's just give one example. In the future, my word processor, I'm going to hit a button and say, give me a legal brief that describes this, and it's going to get locally generated. My video conferencing, my Teams or Zooms, I'm going to say, give me, real-time translation across multiple languages, for this meeting. And I'm going to have that in real time on my PC. My games, for my, all of that is going to become synthetically generated worlds locally on my PC in real time. So we see it across creator, across productivity. And as I've said, this is sort of like a Wi-Fi moment, for the PC of the future. And that begins with our Meteor Lake launch in the second half of this year.
Pat, quickly, a $1 billion pipeline for AI products through 2024. Just give me a sense of the pace at which that pipeline is growing now.
Yeah, we had a super exciting quarter. As I said, we 6X'd that pipeline in Q2, so we saw a huge uptick on that. And I've deployed a lot more sales resources, software resources, to jump on those opportunities worldwide. When we have our Gaudi 2 chip that is, now in volume, we've just seen the first wafers on the next generation Gaudi 3, which will be our 2024, product, and then we have our 25 and 26 products underway. So, we're seeing a lot of momentum there, and the world is looking for a great alternative, an open alternative, a more cost-effective alternative, and Intel is a trusted supplier. We think this is a great, area for us to put a lot of energy into, and we're seeing the response from the marketplace now.
Intel CEO Pat Gelsinger, we appreciate your time here on Bloomberg TV and radio. Thank you.
Thank you so much. Always a pleasure, Ed.
Coming up, a chip equipment maker is showing signs of relief for the market. What one company's strong earnings could mean for the future of the industry. Fast start to this Friday. This is Bloomberg Technology.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general. But the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Time for Talking Tech. First up, KLA reported strong earnings for the current period. It signals that the chip industry may be nearing a recovery. Shares increased around 4.5% in the session, but it's unclear how long this upswing will last. Of course, it's a sign that chip makers are ready to spend on new equipment. Plus, a burning ship near the Netherlands has almost 500 electric cars on board. The cause of the blaze is still unknown, but the Coast Guard has denied reports that the fire broke out in the section of the carrier where the electric cars were stored. And finally, China has asked its largest tech companies to provide case studies of their most successful startup investments. The ask is a sign authorities are ready to grant them broader leeway after a crackdown that brought them to a virtual halt 2 years ago. All right, coming up, Threads, the Twitter-like app, might help bring the center of internet culture back to Meta. We'll take a look at the new app and its potential impact. This is Bloomberg Technology.
I don't think we can replicate Tesla. Tesla is unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
City. In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome back to Bloomberg Technology. Ed Ludlow here in San Francisco. A quick check on the markets. NASDAQ 100 up 2%. Strong end to the week. It's an interesting picture because a lot of tech shares are trading on some strong economic data. We had that surprisingly strong GDP print 24 hours ago, some measure of inflation, show inflation easing. And at the same time, we're all kind of hyped up about AI. But you look at the earnings week we've just had, and there's a big focus on a lot of these tech names trading on their fundamentals. Their core legacy businesses have done well. We will get into that in just a